Zuckerberg down to business, saying that he's going to create a more profitable, successful version of the company as it is today.
Sarah, should we question his commitment to the metaverse?
I think that we should expect that the metaverse commitment remains. I think that he's pretty obsessed with it, but he does seem to be walking back from the idea that this is going to be some big thing he should be talking about on these earnings calls. He's been talking about messaging for almost a decade now. I think 2014 is when he acquired WhatsApp and spun out Messenger into its own app. And it's just now that he's starting to talk about real numbers on messaging. So think about the metaverse in that context. For years and years, investors were asking, when are we going to see real money out of WhatsApp? When are we going to see real money out of Messenger? And he said, take your time, hold your horses, it's coming, it'll be big. Now he said they're at a $10 billion run rate, which doesn't mean much when anyone says run rate to you.
All right,
Thank you. That is so true.
Sarah, I'm going to have some fun with you. And did Mark Zuckerberg go to CEO school and all of a sudden say, hey, I've got to act like a leader of a massive company, and I've got to think about costs and all those serious things that most heads of companies have to think about, and that's kind of how he came out?
Well, I think a little bit. I think the economy turned down, and inflation and Ukraine and all those things that affected the ad spending last year. I think it's easy if you're somebody like Zuckerberg, who has mostly led during growth. Like every time there's a downturn, every time someone says there's a downturn, tech survives, Facebook survives, Meta survives, and continues to invest, and they have to invest through it. Well, I think this is a different scenario, and maybe they shouldn't have hired as quickly as they did during the pandemic, and maybe they shouldn't have spent willy-nilly on things that they weren't sure were going to be lucrative in the future. So I think they're trying to be more disciplined, and he doesn't really need to go to CEO school. He can see the stock drop last year, and all his employees can see the stock drop last year, and ask each other and themselves, what did we do to deserve this? What can we do to fix this? Because that's really the message that hits home for that base.
How much is Mark Zuckerberg looking over his shoulder at TikTok?
He really, I mean, that has been a key driver of a lot of the changes at Meta over the last year. We've seen them completely change the way that the algorithm works on Instagram and Facebook. We've changed the very meaning of what kind of content you see on those sites. It's not just your friends and family and the people you've chosen to follow. Meta is making suggestions for you, telling you that you might want to watch this or that video. In part, that was necessary because the regular users aren't sharing quite as much as they used to. So Zuckerberg needs to fill up that space with content that will keep you glued, and it seems to be working. Becoming TikTok, it may not stop TikTok's growth, but it will at least help juice Facebook and Instagram for the next generation.
We're living in interesting times, man. I feel like whiplash a little bit today.
Nobody in my feed on Instagram are people like I actually follow or know anymore. And yet I keep opening it up again and again, Carol.
You're one of those, huh?
Yeah.
All right,
I like
folks.
to see the airplanes.
Sarah Fryer, thank you so much. Bloomberg News Big Tech Team Leader. Check her out on Twitter. You're listening and watching Bloomberg Business Week on Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 2:21 on Wall Street. I'm Charlie Pella. We've got the Dow lower right now, the S&P off session highs, and NASDAQ moving higher. Let's begin with the NASDAQ Composite Index up now by 3.1%, up 370 points to 12,187. NASDAQ 100 Index up by 3.4%. We were just talking about Meta Platforms with Sarah Fryer. We've got Meta surging now by 26%. The S&P 500 Index up 53, up 1.3%. The Dow down 134, decline there of 0.4%. Bottom line here, stocks adding to gains sparked by speculation that the Fed's tightening cycle may be nearing its peak. 10-year yield 3.39%. We've got the 2-year yielding 4.08%. Spot gold down $35 the ounce, drop there of 1.8%. West Texas Intermediate crude flat on the day, $76.38 a barrel. Briefly, we've got Carvana shares surging again today, putting the used car dealer on course for its 6th session of gains. Right now, Carvana is up by about 17%. You recall it was up 33% yesterday. Recapping, S&P up 1.3%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. Well, remember on Monday, the White House said that the COVID-19 national emergency and public health emergency will be extended to May 11th, but then lifted, and it's really a change or a sign of changing times. It's a milestone in a coronavirus response here in the U.S. that dominated much of the early weeks of President Joe Biden's administration.
Yeah, but at the same time, we're seeing the new variants are showing that they have an ability to evade protection provided by vaccines. We've got a lot to get to. Very pleased to have back with us Dr. Andy Pekosh, professor of molecular microbiology and immunology at the Johns Hopkins University Bloomberg School of Public Health. On the phone from Baltimore, the Bloomberg School of Public Health, it is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Good to have you with us, Dr. Pekosh. Okay, so the national emergency ending May 11th. How should we read into that as people who are coming out of a pandemic, but also as people who need to understand, okay, well, who's going to pay for COVID tests now?
Yeah, so there's, I think, two major things that are going to go on here. One is, people perhaps don't realize how many things the government was paying for to make sure that there was equitable distribution of vaccines, testing, treatments, healthcare for anybody that was infected with COVID-19. Much of that is going to go away when the public health emergency isn't in place. Insurance companies will pick that up, but it will very much depend on the types of insurance that individuals have. I think from the pandemic point of view, it's really a sign that we're moving into a phase that's moving away from the emergency responses and trying to put in place things to deal with COVID-19 as a disease that we're not going to get rid of, that's going to be with us going forward, and that we have to readjust our strategies to deal with it as a known, constant concern that we'll have to use our public health interventions and our medical interventions to try to minimize severe disease.
Dr. Pekosh, is it fair to say it's just like the common flu?
No, we had a big flu surge this year, and what that really showed us is that COVID-19 is still giving us more cases than influenza, and COVID-19 is still resulting in more hospitalizations and more deaths on a per-case basis than influenza. So it's something that is even more of a concern than influenza. We are concerned about influenza as a disease annually. So it's something we need to keep our eyes on, and we need to keep using antivirals, vaccines, and public health messaging to make sure that people keep their guard up against it.
To what extent do we need to be keeping our guard up against it? And I asked this in the context of our conversation that we had with Amish Adalja, your colleague at the Bloomberg School of Public Health, just a few weeks ago. And he really surprised me with his answer to my question about boosters, essentially saying that, for many people, he wouldn't suggest a booster.
Yeah, well, we are seeing that the severe disease is coming through in the populations we expect. The elderly, those with secondary medical conditions, those continue to be the at-risk populations. I think we run the risk of thinking about vaccinations against COVID like we do against seasonal influenza, and they're still very different diseases. So we still have a little bit to learn about how to best use these boosters, use these vaccines, but also understand that the virus is going to constantly be changing, and the boosters may not be as effective as we want them to be, nor will they be that effective over the course of a year.
What do you mean by that, that we run the risk of treating it in the same way? Is that, in the comparison is we're given the recommendation to get a flu shot every year, but perhaps we don't need to get a COVID booster every year?
I think we probably will. The question is, at what time of year do we get that booster? COVID really hasn't shown the seasonality that we see with the flu. So with flu, we get our vaccines in the fall because we know that in the late fall and winter, we're going to see a surge of cases. We still haven't seen that pattern with COVID-19, so we may need to adjust the booster time depending on when we see surges of cases.
Okay, so it is kind of interesting because I'm thinking about what kind of community immunity have we built up so far? Do we have any idea on that?
Yeah, we've built up a lot of immunity in the population. That immunity seems to be protecting more against severe disease than it's protecting against infection. So that's a little bit of a surprise, I think, for us. And I think it brings up what we're going to have to be dealing with. Is we're going to have to dealing with these cases that are going to be occurring perhaps across the entire year, and really paying attention to when the situation merits a booster, because we're seeing surges in cases, particularly in populations that are highly vulnerable.
Okay, so where does it leave us in terms of variants? Are we going to see variants develop that are continuing to be perhaps, more evasive for vaccines, but at the same time not have the strength that earlier variants had?
Yeah, I think one of the things that we're seeing the signs of right now is that the COVID variants that are emerging now have some ability to evade vaccine-induced immunity, but not a lot. And we think the virus is now sort of maybe moving in this little area where it's going to be responding a bit to the population immunity, but it's not going to make the major jumps like we saw when Omicron first emerged a little bit over a year ago. So signs are looking good that we're settling into a stage where the virus will be mutating, but we'll be able to adjust our responses in terms of vaccines and those strategies because we're not seeing major jumps in how the virus is behaving like we did during the first 2 years of the pandemic.
Is there a possibility that at some point in the future there could be a variant out there? I mean, anything's possible. I guess we know that. But are you guys talking about it, a lot, that they could be the possibility of, once again, a variant that shuts kind of society down again? Or do we have a sufficient enough playbook that we can manage our way through?
Well, we are concerned about certain populations, for instance, immunocompromised people who may be able to generate variants that are even more evasive or transmissible. A lot of efforts are being done to monitor those populations to look for those signs. I think the positive sign is that we know antivirals are working and we know how to update the vaccine. So even if a new variant emerges, the response in terms of treatments and vaccines will be much, much faster now that we know so much about how to deal with COVID.
Still, often days, we see hundreds of people dying. When will that stop?
Yeah, and that's the big question that we don't have an answer to right now. It is important to note that we're having lots of people getting infected and dying constantly over the year, and that's something we haven't seen with the respiratory infection. All other respiratory infections come in waves. They're gone for long periods of time, and then they come and surge back, and then they leave. We haven't seen that pattern with COVID-19, and that's really the big variable that is going to impact as we mentioned before, boosters and treatments and all those interventions that we have.
Wow, it's an interesting time. It does feel better, but yeah, certainly something that we know we have to continue to keep on our radar. And we do actually when we think about China in terms of the reopening of its economy. Dr. Andy Pekosh, thank you as always, Professor of Molecular Microbiology and Immunology at Johns Hopkins University Bloomberg School of Public Health, of course, supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies, joining us on the phone from Baltimore. All right, it's a pretty big day here, and we've got, as we said at the top, $4.7 trillion worth of market cap value that will be reporting earnings in the likes of Apple, Alphabet, and Amazon. And this on a day where we continue to see that Fed rally really take over. I mean, the expectations are, at least according to traders, they're thinking Fed is almost done. They could even cut rates later on this year, but we know Jay Powell said very differently.
Yeah, the question is, who's right? We're going to talk about that with Liz McCormick in just a few minutes, because that is the cover of Bloomberg Business Week. Carol, to your point about the rally, the NASDAQ up 2.8% right now. That puts it at 16% already this year. The NASDAQ 100 up 20% from its December lows back in a bull market.
Yeah, we'll see how we close, and whether or not it's just another head fake, which is exactly what the cover story gets into. This idea that investors, traders, what the markets, what investors think, at odds with what the Fed has been clearly laying out. It's not until March that we get another new update on projections, and we'll see whether or not the Fed and the FOMC members move it all on that.
Right, but FOMC members are going to start speaking. We're going to start to hear from them very soon, and the way that they speak, what they say about Fed policy and how they're viewing financial conditions is really important.
And it's a global thing. Let's not forget the ECB and Bank of England both raising rates, and ECB telling there's more to come. So you got to remember that this is happening on a global level. All right, you are listening and watching Bloomberg Business Week. Carol Master, Tim Stanovic. Off to DC we go with a check on world and national news, and Nancy Lyons. Hey, Nance.
Thanks, Carol. Democratic Congresswoman Ilhan Omar is no longer on the Foreign Affairs Committee. She was ousted today for controversial and anti-Semitic remarks.
The ayes are 218, the nays are 211, with one answering present. The resolution is adopted.
Speaker Kevin McCarthy says her comments could threaten national security. Democrats, though, note Omar has apologized for her remarks and say today's vote was more about political revenge for Democrats removing Marjorie Taylor Greene and Paul Gosar from their committee assignments when they held the House majority. A Democratic senator is adding to the Washington pressure on TikTok. We get more on that from Bloomberg's Nathan Hager.
Senate Intelligence member Michael Bennett of Colorado is asking Apple and Google to remove the Chinese-owned video sharing app from their app stores. In a letter to the company's CEOs, Bennett says there's a risk the Chinese Communist Party could weaponize TikTok's user data against the United States. Several Republican lawmakers have urged an outright ban on TikTok. Bennett is one of the few Democrats to take an aggressive stand against the app. In Washington, I'm Nathan Hager, Bloomberg Radio.
Aides to President Biden and India's Prime Minister Narendra Modi are discussing a possible state visit to Washington this year. So far, the president has only hosted French President Emmanuel Macron for a state visit. The U.S. and India are working to share advanced defense and computer technology. Well, Texas is facing a fourth day of an ice storm that's caused power outages, grounded flights, and triggered deadly accidents. The latest cold snap comes almost 2 years after a storm in the state caused the electrical system to fail, leaving millions without power. State officials have made a number of reforms to the grid since then, and Texas Governor Greg Abbott says there's plenty of electricity. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 2:41 on Wall Street. We check the markets all day long at Bloomberg. Stocks are trading mixed. The Dow now lower by 200 points. S&P, NASDAQ, both very much in the green. But we begin with a developing story in this headline from the Bloomberg Professional Service. Sources tell Bloomberg the FBI is seeking information on a cyber attack on London-based Ion Trading UK that has snarled global derivatives trading. S&P 500 index rallying 39 points, now up by 1%. The Dow on the minus side by 200 points, down by about 0.6%. NASDAQ, though, is surging by 2.6%, up 305 points. Meta Platforms leading the way higher, up now by about 24.9%. The NASDAQ 100 index up 2.9%. 10-year yield 3.39%. Spot gold is down $35 the ounce, down 1.8% to $19.14. And West Texas Intermediate crude oil down 0.8%, $75.83 a barrel. The Bank of England raised interest rates half a point today, saying more increases will be needed if signs of an inflationary spiral persist. And the European Central Bank raised rates by half a point and pledged another such move before officials then take stock of where borrowing costs must go to tame inflation. Here's European Central Bank President Christine Lagarde.
In view of the underlying inflation pressures, we intend to raise interest rates by another 50 basis points at our next monetary policy meeting in March, and we will then evaluate the subsequent path of our monetary policy.
Carvana shares surging by 10.1% right now after earnings. Harley-Davidson is up 9.6%, but after earnings heading in the very different direction. Hanes Brands, the maker of Hanes underwear and Champion athletic apparel, provided weaker than expected sales and profit forecasts. Right now we have got Hanes is moving lower. Hanes shares down right now by 26.8%. Again, recapping, stocks mixed. The Dow lower, S&P, NASDAQ both higher. Big rally for NASDAQ, up 2.5%, S&P up 0.9. And that is a Bloomberg Business Flash.
Right, but definitely some selling off the highs of this session, so we'll see where things go. U.S. stocks, though, adding to yesterday's gains, sparked by speculation, the Fed's tightening cycle and maybe nearing its peak. You know, we were hearing from Charlie talking about what's going on at the ECB and Bank of England, constantly global central bankers reminding us, hey, folks, there's more to come. We still got to fight to bring inflation down.
Well, it's perfect timing for this week's domestic cover story. The story written by Bloomberg News senior markets reporter Katie Greifeld and Bloomberg News chief correspondent for global macro markets, Liz McCormick. Liz joins us now via Zoom in New York City, along with Bloomberg Businessweek editor Joel Weber here in our Bloomberg Interactive Brokers studio. The cover of this is perfect, Joel. It's clearly a Fed Chair Jay Powell staring down a bull. And I got to tell you, it seems like today and yesterday, that bull has the upper hand.
Yeah, well, that was why we wanted to do it as a cover story. When I think about this year and sort of the big stories of the year, this really does feel like it's going to be one of the big ones. Look, we've had the Fed that has been intent on continuing to raise rates. Wall Street really wants that cut at some point. When and how that all plays out is going to probably impact what the markets do all year long. So Liz, like we wrote it as a walk-up, and then yesterday unfolded. What do we know now that we didn't know going in, and how do you feel about how our cover stories hold up?
Oh, well, I think the story holds up, and like Tim said, as of yesterday, the market still kind of feels like they have the upper hand. Like Chair Powell, whether he meant to or not, he didn't kind of push back hard enough to kind of break the animal spirits that are out there. But I think, like you said, this is like an all-year story. Like, we're not going to know until, let's just say, the second half, if the markets will have capitulated if the economy remains strong and inflation is sticky and the Fed is making clear they are definitely not cutting, or if the world changes and we do get a full-fledged recession and the Fed starts leaning. So we're not going to know for a while. So like you can say round one market, Fed didn't push back, but I just think this is going to be going on for a while. And right now, I mean, maybe Chair Powell wanted just to leave kind of options open, but it was, definitely interesting. I mean, especially in Europe, like Charlie was mentioning what's happening in the European Central Bank and stuff. The bond market rallied even after that, with Lagarde saying another 50 is coming. So the bond market just has this kind of bulls taking over.
It's interesting, Liz, because you and Katie included a comment in this from Neil Kashkari, of course, the president of the Minneapolis Fed. And he basically said he's been around long enough to understand that there's this optimism when it comes to Wall Street. And it seems like optimism is what's driving this. But then you include this other part of his quote that he gave to the New York Times. He said, quote, "They are going to lose the game of chicken, I can tell you that." This is a guy who has been known as a dove and is now coming out increasingly in 2022 and this year hawkish.
Yeah, and it's interesting. Our Fed team in D.C. did a story a bit back saying, just like you're saying, Kashkari, who was the biggest dove, has like become the biggest hawk. And I was like curious. Oh, I'd love to call him and see what did you think of what Chair Powell said yesterday? Because it didn't kind of embolden that chicken fight of the Fed winning. But yeah, I think it's pretty telling. And I just think that. I guess the market's supposed to see ahead, especially the bond market. Sometimes they get it right, sometimes they get it wrong. They've been kind of all over the place. But I mean, the market kind of sees the pivot, and we all know bonds got brutalized last year, as did stocks. So people felt like, oh, higher yields.
Okay, traders, hello again. As you can see, a few hours ago, we already sold short Bitcoin. All of you guys who managed to do this, I was away. I had a very important meeting. And when I came back, we're already in profit. It's a nice trade. Let's see how far we went with two, positions. As you can see, we have two positions. One we sold short, I think it was yesterday. Another position was opened today, just at 6 o'clock, I think, 6:15. I will see. So, what's going to happen next? I will have to calculate at what level I will have profit from two positions, and then I will let you know what's going to happen next with two positions on Bitcoin. If it's a bit complicated for you guys, please, you need to get either a purchase webinar. I will provide live webinar, or you can get the strategy, and I will explain everything on webinar. If you will have questions, you can ask me live any questions, or you can get the strategy and you can see how I trade top securities, FTSE 100, Forex, Bitcoin. Okay, guys? I'll speak to you later. Well done, all of you guys who followed my trade and decided to trade with me.
Next moment that I think the people are going to be all over this, and not to say Jay Powell might not need to talk again to cool down these spirits a little bit, but Liz, what do you think the market will be especially looking for in that next round with the Fed?
Yeah, I think it's if that median dot moves down from 5.1, which means they could do another hike and then maybe be cutting. Those dots could show. And that was one thing that happened yesterday in the press conference. He was asked about that. Like, basically, do you stand by those December dots? And he was like, well, and the market didn't like that. He just didn't say, yes, we do. He said, that's what we put at the time, where we'll revisit the data, which is fair. And, so some people didn't like that. But I will add that he did say, and if things change, those dots could go higher. So it wasn't that he said they're going to go lower. So I think, sometimes people in the market grab what they want to hear, and a little bit of like a Rorschach test, so.
Well, what stayed with me was that he's like, we're going to bring it down to inflation. We're at the Fed funds, and we're going to get inflation back down to 2%. We heard that from ECB too, right?
2% seems real. Like I was like, well, maybe it's 4%, maybe it's 3%. And it's like, no, it's going to be 2.
Exactly. So that was pretty clear. Great message, great story, great cover story of Bloomberg Business Week. So relevant to this week's news. Liz McCormick, Chief Correspondent for Global Macro Markets at Bloomberg News, writing it with Bloomberg's Katie Greifeld. And our thanks, of course, to Jill Weber, editor of Bloomberg Business Week, here in our interactive broker studio. We do have stocks rolling over, still up about 2.5% though on the NASDAQ, and just shy of 1% gain on the S&P. Yeah, the rally continuing. This is Bloomberg.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pella. 253 on Wall Street. We've got Meta Platform shares rallying after the Facebook parent reported better than forecast revenue for the fourth quarter and boosted its stock buyback authorization by $40 billion. Now, a lot of analysts have been raising their price target after the update. Meta shares up now by 24.5%. Harley-Davidson shares, they're up now by 9.6%. Harley reported fourth quarter profit and revenue that did beat Wall Street's estimates. And with more on the Harley story, here's Bloomberg's Steve Rappaport.
Shares of Harley-Davidson are roaring, fueled by fourth quarter profit and revenue that beat Wall Street estimates. The Milwaukee-based motorcycle maker reported sales of $1.14 billion. Analysts predicted $920 million on average. Harley-Davidson CEO slashed costs, pulled out of underperforming markets, and tightened inventory as part of the company's turnaround plan. Harley projects revenue growth of as much as 7% for the year. Steve Rappaport, Bloomberg Radio.
And again, Harley-Davidson, it uses the ticker HOG, H-O-G, up now by 9.7%. Estee Lauder lowering its profit outlook for the second half of the year due to ongoing COVID-related challenges in China. Shares of the beauty company down now by about 4.7%. Eli Lilly falling after fourth quarter sales of a key diabetes drug missed estimates. We've got right now shares of Eli Lilly down 4.6%. Stocks are mixed. Coming up, we'll recap the markets. Those are some of our company stories. I'm Charlie Pellet, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
It is Bloomberg Business Week. More Business Week coming up in just a moment. First, though, a check on the latest world and national news with Nancy Lyons in the 991 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. A special celebration is underway at the White House to commemorate the 30th anniversary of the Family and Medical Leave Act, guaranteeing many Americans the ability to take up to 12 unpaid weeks off to recover from major illness, childbirth, or to take care of a sick family member. It was one of the first pieces of legislation signed by former President Clinton.
The bill was the result of years of passionate advocacy and effort by so many people.
Clinton says it took numerous vetoes and support from Republicans before it eventually passed. The goal of creating paid family leave received a long round of applause at today's event. That bill failed to pass in 2021. Well, the House today passed a resolution denouncing the horrors of socialism. Most Democrats joined Republicans in voting for it, but many Democrats were dumbfounded the proposal was even necessary. We get more from Bloomberg's Irv Chapman.
The resolution was presented by Chairman Patrick McHenry.
It outlines the pain and hardship experienced by millions around the world who have suffered under a socialist regime. There's nothing in this resolution about banning social services or anything of the like.
Opposition was led by Ranking Democrat Maxine Waters.
This resolution today does nothing except spread lies and fear about a threat that doesn't even exist.
Both sides used the debate to cite policies they oppose. For Republicans, climate change regulations. For Democrats, threats to Social Security and Medicare. In Washington, Irv Chapman, Bloomberg Radio.
U.S. health officials are advising people to stop using Esri Care artificial tears. Those are over-the-counter eye drops. They say they've been linked to an outbreak of drug-resistant infections in the blood, urine, and lungs. The CDC has sent a health alert to physicians saying the outbreak includes at least 55 people in 12 states. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. This is Bloomberg. Back to you, Carol and Tim.
Thank you so much for that update, Nancy Lyons. Bloomberg Business Week is brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. If your business was hurt by COVID, it may qualify for a payroll tax refund. Even if you took PPP, your business may still be able to claim the Employment Retention Credit. See if your business qualifies for ERC assistance at getrefunds.com.
Well, February is Black History Month, and every day this month we're celebrating significant moments in U.S. Black history. Now with your installment for Thursday, February 2nd, here's Bloomberg's Justin Milliner in our studio.
Thank you, Carol. On this day in Black history in 2009, Eric Holder became the first Black Attorney General of the United States of America. He was tapped for the role by, of course, then President Barack Obama. He ended up serving 6 years in that position, making him not only the first Black U.S. Attorney General, but also the third longest serving Attorney General to date. His first month on the job, of course, was Black History Month back in 2009, and he made waves in Washington at the time during a speech for his pointed assessment of race relations in the United States.
Average Americans simply do not talk enough with each other about things racial. It is an issue that we have never been at ease with, and given our nation's history, this is in some ways understandable. We must feel comfortable enough with one another and tolerant enough of each other to have frank conversations about the racial matters that continue to divide us.
That's Today in Black History. I'm Justin Milliner, Bloomberg Radio. Carol, Tim.
All right, Justin, thank you so much. More from Justin throughout the month. In the meantime, we're going to get more on the markets in just a moment. We're going to head over to our TV colleagues. Definitely have seen stocks move off their highs of this session, so we're not seeing a bunch of buying as we head into the last hour of trading, and we've got some big earnings coming up, Tim.
Oh, yeah, we got Apple, we got Amazon, and of course, we got the big one, Alphabet, as well.
What do we say? $4.7 trillion worth of market cap reporting after the close.
That's just from you.
Talk about the potential to move things. All right, folks, we're heading over to our TV team, Katie and Scarlett. Bloomberg's countdown to the close. It starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close. We've got 60 minutes left in the trading session. I'm Scarlett Fu here with Katie Greifeld. And of course, we're joined, as always, by our colleagues Carol Masser and Tim Stenovic in radio. And of course, in doing so, we welcome our full Bloomberg audience across TV, radio, and YouTube. Carol, yes. I was going to say we're on a risk-on day that's got an incredible rally going. And of course, we've kind of given back some of our gains over the past hour.
We have indeed, right? You know, here we are going into our last hour of trading. We're not necessarily seeing buying, but we'll see what happens. But a lot of what's going on, conviction, yep, there's some volume up in a big way on the S&P 500, but a lot of it has to do with those big tech names. Having said that, it made me want to look at the ARK Innovation ETF because it is definitely outperforming. It's up another 5%, up almost 9% at its highs today. I mean, this is after having its best January month on record because it was up about 28%. But keep in mind, it is still about 67% off its February 2021 high. Kathy Woods, she's been buying the likes of Tesla, Coinbase. She is going to be our guest on radio, TV, and on YouTube, and of course on Bloomberg Original. She's going to join us at 3:30 p.m. So we'll see what she has to say about this rally.
Yeah, looking forward to that conversation. This rally got me looking at where we were a little over a year ago, Scarlett, and right now we are only 13.3% off of all-time highs on the S&P 500 right now. So the question is this rally, has it, gotten a little out of hand for people? I don't know. Will we hear from Fed officials next week and in the coming weeks trying to tamp things down? That question remains, but right now it looks like the bulls are winning when it comes to staring at facing off with Jay Powell.
Especially when you look at the big tech cap names. Certainly the NASDAQ 100 at one point looked like it was going to enter a bull market. It has come back a little bit off those levels, but still very, very close to up 20% since its December low. And we have Apple, Amazon, and Alphabet reporting today. That should really either push us over to that bull market or take us farther away.
And it's funny to see there the Dow Jones, just the odd man out. But if you look at this sector level, it's interesting. Even though you do have the S&P 500 solidly higher right now, it's a mixed bag on the sector level. You have 6 higher, 6 in the green, 5 in the red right now. You look at what's leading, it's communication services, it's consumer discretionary, it's information technology. So those are the winners. What's not doing so well, it's energy. That sector off about 3%, and healthcare down 2%, though you do have some material weakness in the consumer staple sector as well, that off by 1%. So that's more specific than just the index level. Let's get even more specific and look at some of the single names. And like I said, I mean, big tech, it's really roaring today. Meta Platforms, year of efficiency. That's what we heard from Mark Zuckerberg.
I'm sorry, I can't help but laugh when I hear that.
I mean, shareholders love it. Maybe it's a welcome change from the metaverse. In any case, Meta shares up 23%. Zuckerberg said that they're working on flattening their org structure, deploying AI to help engineers be more productive. The list goes on. In any case, shares soaring. That is providing some needed relief to Snap. Remember, the story out of their earnings was weak ad demand. Well, you're seeing those better expected revenue figures from Meta dragging that stock higher as well. And then you look at some of the losers, like I said, energy down on the day. That's definitely bringing down the likes of Exxon and Chevron as well.
Yeah, money moving out of the stocks, energy stocks, the more defensive plays, and into growth again, which of course become very sensitive to interest rates. I wanted to look at financial conditions because it's top of mind for the Fed. It's a big part of the Fed's dashboard. Well, there you go. It's all Jay Powell thinks about, we think. But according to Neil Dutta of Renmac, Powell noted yesterday that financial conditions have tightened a lot over the last year. We heard that, but if you look at what's happened over the past couple of months since October, it's now at its loosest since February. So it's interesting that Jay Powell chose to frame financial conditions in this super dovish way as opposed to what we've seen since October, which
really grinds my gears.
It's a complete round trip. What do you make of that, guys?
I'm sorry. Katie had me at grinds my gears.
I will say that, we talked about this a little earlier with international economics and policy correspondent Michael McKee, and he pointed out that there are 7 different indices when it comes to financial conditions, and each one tells a little bit of a different story. So you can kind of use each one of those to back up the story that you have. And it seems like he chose one. Probably the Goldman Sachs one is the one that he was referring to, Mike said. And that shows that story.
Not the Bloomberg one?
I know. But,
Shame on him. But that's a good point that there's different ones, right? So it depends on which one you're looking at that maybe tells a different story because they're not all telling the same one.
That reminds me of what Nathan Sheets just told us. He said financial conditions are like a fruit salad. You pick whichever one.
Little buffet, right?
Yeah.
Having said that, I think it's a big week, no doubt about it, for global central banks, right? We had FOMC, Fed, our Fed yesterday. We had the B of E and also ECB this morning. It does feel like we're hearing a very similar story from many of them. The European Central Bank lifting rates by another 50 basis points, pledged another such move. European Central Bank President Christine Lagarde spoke at a news conference earlier today from Frankfurt. Here's what she had to say.
The Governing Council will stay the course in raising interest rates significantly, at a steady pace, and in keeping them at levels that are sufficiently restrictive to ensure a timely return of inflation to our 2% medium-term target.
All right, so Christine Lagarde, of course, of the European Central Bank earlier today. So saying they're not done, that's what the Fed said, right? We are not done. I guess time will tell. March, that dot plot's going to be so crucial if they start to kind of change their projections for the Fed funds rate.
Yeah, but as we've been saying throughout the program today and yesterday, the traders hear what they want to hear, and what they hear is more dovish than I think what a lot of people hear are certainly some hawkish signals coming from central banks around the world.
I'm so glad you bring that up. People hear what they want to hear. I mean, that's kind of the thing I've learned as I've gotten older. And it felt that way when we saw the market react, the bond market react to what Jay Powell was saying.
Italian bonds?
Yes, Italian bonds, or even the U.S. bond market, right? Because yesterday Powell said, or he was asked specifically whether the December dots that show FOMC members' forecast for inflation or the terminal rate were valid. He didn't say yes, and people took that to mean, okay, there's a chance here, there's room here. We could maybe see the Fed not do what they're going to do. And so this was my tweet. You're telling me there's a chance.
Yeah, there you go.
Okay, for everyone on radio, we're looking at Jim Carrey in Dumb and Dumber.
My first meme ever.
Scarlett made a meme. It says in big font, so you're telling me there's a chance. Katie, have you seen Dumb and Dumber?
I have not seen
I
Dumb
called
and Dumber.
Scarlett. Did I say this yesterday?
You totally predicted
I called this.
You know what's embarrassing? Romaine Bostic told me yesterday to watch Groundhog Day for today, and I didn't put it together that today is Groundhog Day.
It is Groundhog Day all over
There's
again.
always next year, Katie.
So we're going to come up with another meme for you or another movie for you that you might not have seen.
Yeah.
I'm just going to tell you, Katie, someone's sending me a message on the Bloomberg that you're too young to know about grinding gears.
Wasn't it on Family Guy? In any case, thank
in
you
the
for
right context,
watching.
she knows everything.
To be continued. We've got some big tech earnings, Apple, Alphabet, and Amazon after the bell. We'll be back to break them down. All right, guys, that's a wrap. Our cross-platform coverage, radio, TV, Bloomberg Originals, and, of course, on YouTube. We will be back at 4 p.m. Wall Street time. In fact, we're going to be back at 3:30 p.m., too, on TV and radio, our interview with Kathy Wood. That's coming your way, and then we'll count you down to the close right here on Bloomberg.
We can work it out. We can work it out.
All right, everybody, we are focused certainly on this rally. We're focused on the tech earnings after the closing bell. But, as we talked with our Mike McKee earlier, we did get some economic reports earlier this morning, including reads on non-farm productivity. That was good, a rise in productivity. That helps the Fed to bring down inflation. But we also did get a read on the labor market, Tim.
Well, tomorrow we got a big labor number, too, coming. So the question is, does it show softness that the Fed wants to see? Let's get into it with Julia Pollack, chief economist at ZipRecruiter, with a jobs report preview and a survey of recently hired workers. She joins us via Zoom from Los Angeles. Julia, always good to have you with us. We've spoken to you in the past, and you and the other folks at ZipRecruiter have used the term that workers have been, in the last couple of years, in the driver's seat. I want to go back to that comment. Are they still in the driver's seat?
So the interesting thing about labor market data the last couple of months is that it's been like a roller coaster ride, with 1 month suggesting, an imminent downturn, and the next pretty rosy. So this week things are looking up for the U.S. job seeker. We had productivity data show a big increase. We had job openings surge 600,000 to 11 million again. So there are 1.9 job openings for every unemployed American. We also saw the stock market pick up, consumer confidence increase, European economies doing better than expected. And so right now it looks like perhaps the labor market is still very tight. It's not softening, it's not slackening. And employers are going to get a rude awakening if they hope that bosses are back in town and that they'll be calling the shots.
Julia, give us perspective though. Are we back to 2019 levels pre-pandemic, or are we, give me a little perspective here.
So some labor market indicators are tilting back to normal. For example, working hours and temp help services. So at the start of the pandemic, when there were these really acute labor shortages, employers were short-staffed and they had to squeeze as much productivity as possible out of each individual worker and excessively rely on contract workers, temp help workers, and overtime hours. That led to burnout, to a work-life balance crisis, and a retention crisis. Now we see that the work week has fallen back down from 36 hours to 34.3 hours, sort of at the bottom range of what's good in normal times. Usually a decline in working hours is a bad thing. It shows that the economy is losing steam and that employers are cutting hours of workers and will cut actual headcount later. But this time, a decline may actually be good. It may show that the economy is recovering normal staffing, that companies are back at full steam and able to sort of restore normal practices again. So far, most of the indicators that have been negative, that have been falling, actually show signs of renormalization, rebalancing. The question is how far further they'll fall.
Well, all of this sounds pretty great if you're an American worker, of which there are tens of millions of those. You know who it doesn't sound great to is anyone on the Federal Reserve. Because if you're seeing JOLTS data like we saw yesterday that shows that for everyone looking for a job here in the U.S., there are 1.9 positions open, that means that there could be concerns about a wage price spiral. What do you make of it?
Well, so far, in recent months, inflation has come down quickly, and it's come down more quickly than wages, but wage growth has also moderated. And so that suggests that a wage price spiral hasn't set in. That said, we now have a situation where in the last 5 of 6 months, U.S. workers have actually seen real wage gains because wages are growing faster than inflation, than prices. And so perhaps they'll now feel, confident again and ready to go out and buy. And that could drive prices up. So it's a delicate balance, and news that's good news for workers may be good news in the short term, but bad news in the long run if it fuels further inflation and forces the Fed to raise rates higher and keep them higher for longer.
Yeah, that's exactly where we are. We can each make the side of the argument. It's a tricky point, although markets certainly leading in a big way in the last day or so in terms of risk on and believing things are going to get easier and the economy will be okay. Julia, what are some of the interesting trends you're seeing when it comes to job postings on your guys' site?
So one thing we found very interesting was that new hires, people who just got hired in the last 6 months, got a better deal than those hired in the first half of the year. And that's surprising because there are so many indicators that the labor market has softened a little bit. Well, it doesn't seem to be the case when you look at new hires. 36% of them got recruited to their jobs. They didn't have to go out and look for a job. The job found them. About 20% of them got signing bonuses. That's very large historically. Then a huge share of them managed to migrate out of in-person jobs and into remote or hybrid jobs. 39% got a hybrid job. Only 28% were working in a hybrid situation before. 18% are fully remote. Only 12% were fully remote before. And those who are going into the office have managed to cut their commutes substantially from 30 minutes on average to 23 minutes. And so it seems like all around workers are getting a better deal.
They're getting a better deal, but I'm wondering if they're always going to be getting a better deal. I'm wondering if this is going to be a fundamental shift in the way that Americans have a relationship with work. Even in a downturn, do you still see employees having the leverage of saying, okay, I only want to come into the office 2 or 3 days a week?
So you do see a backlash among some companies. There are several companies in recent weeks that have announced return to the office 5 days a week mandates. Whenever this happens, though, many companies very soon have to backtrack because there's such a huge backlash among workers. Overall, we're still seeing the share of remote postings within high remote potential industries like tech and finance go up. Companies are increasingly shifting from taking over 2 floors in an office building to taking just 1, from letting people work remotely on a case-by-case basis to sort of classifying the job as remote from the get-go. And so they're making the kinds of investments and policy changes that support long-term remote work. But it is a difficult issue, and they're also dealing with some of the challenges there for company culture and for productivity and collaboration.
What do you think is the biggest factor, or what are you focusing on in terms of maybe seeing a different trend line when it comes to the labor market? You sound pretty enthusiastic, I've got to say. So what would change that dramatically? Are you concerned about the Fed overdoing it here?
I'm very much concerned about the Fed overdoing it because we already see that it's had a large negative effect on business investment, on housing market activity. And if that continues, there will almost certainly be an effect on employment. So the question is, how far the Fed will have to go. For now, what the Fed has done has sort of almost miraculously, immaculately taken sort of froth out of the market, destroyed almost $12 trillion worth of value in the stock market and in crypto without causing real damage to the real economy and to Main Street. That's pretty remarkable. It's sort of almost a best case scenario. And the question is just how long that can last.
So I spoke about the idea of fundamental shifts in the way Americans work. What about when it comes to hybrid work and the idea that, Americans are now in an environment where it's likely that many jobs are going to allow you to come into the office sometimes. They're going to allow you to work from home, and they're only going to require a few days a week. I'm wondering, if you see that in an environment with layoffs. I have to go back to this once again. If you see that same mentality continuing.
Absolutely. So right now, layoffs are still so low by historical standards. I mean, they're down 24% below what was normal before the pandemic. There are only 3 sectors where that is not the case, and those are transportation and warehousing because of the shift back to services from goods, information because of the way the tech sector has been hit by Fed rate increases, and financial services. Of course, banking, deal-making, IPOs have all been put on pause while the Fed is raising rates and sort of financial conditions are uncertain. Even in those industries, though, remote work is here to stay because it saves workers time and money, and it saves companies money as well.
Just real quick, does it also give companies an opportunity to hire people who they, in past, wouldn't have been able to hire? Is it more efficient?
Absolutely. Well, so many of our clients have converted jobs from fully in-person jobs to remote jobs or hybrid jobs, and they've seen recruitment expand dramatically. Their retention has increased, and wage growth pressures have fallen because they can now recruit across the country in lower cost places. So they gain access to better talent at a lower price.
All right. Listen, we appreciate your time today. Julia Pollack, she is Chief Economist over at ZipRecruiter, joining us via Zoom from Los Angeles. This, of course, when we did get weekly jobless claims, we have been getting Challenger ADP data, and of course, we get the monthly jobs read from the government tomorrow, which markets are certainly focusing on in a week that has just been full of so much, and we've seen a lot more positive sentiment come back into the financial markets.
183,000 is the number expected tomorrow by economists surveyed by Bloomberg. That's down, Carol, only 3,000 from the last month of 186,000. We'll see if there are revisions, though.
Yeah, exactly. That's a good point. And we'll see what's going on with wages and the cost of wage increases. All right, this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We check markets all day long here on Bloomberg. Stocks are trading mixed. Meta surging 24% right now. The Dow lower, S&P, NASDAQ, they're both higher. Let's head right over to the first word breaking news desk for today's afternoon call. And here he is, Bailey Lipschultz.
And good afternoon, Charlie. As you said, stocks are mixed, but mostly higher in a risk-on rally bolstered by optimism that the Fed's tightening cycle is near its peak. The Dow is down 140 points, S&P higher by 45, with the NASDAQ jumping 315 points. The U.S. 10-year yield is at 3.39%, and small caps are higher by 20. 6 of the 11 main S&P sectors are trading higher, led by gains in communication services and consumer discretionary, while energy and healthcare are the worst performers. NASDAQ biotechs are down at 40 points, transports rise 400, semis are up 1%, while the VIX is higher by 7.5%. Leaders in the Dow, Microsoft, Home Depot, and 3M, while United Health, Merck, and Travelers are the worst performers. On the earnings front, Meta soared 25% after results as Mark Zuckerberg pledged to make the company leaner. Align Technology is on pace for its best day since 2013 after revenue topped estimates, and WW Grainger rose 13% to a record after its 2023 sales outlook beat estimates. Wrapping things up, it's another busy day of earnings after the bell, with results due from Alphabet, Apple, Amazon, and Starbucks. Live from the First Word Breaking News Desk, I'm Bailey Lipschultz. Charlie?
Okay, we thank you very much, Bailey. We got you covered on those earnings. And to hear live breaking news over your Bloomberg, type SQUAWK, SQUA, on your Bloomberg terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thank you so much for that update, Charlie Pellet. Really appreciate it. Bloomberg Business Week is brought to you by Audi. Don't let someone else drive off in the Audi model you've always wanted. Visit your local tri-state Audi dealer to get behind the wheel of yours today, or visit AudiOffers.com for more information.
All right, we are keeping a watch on the markets, no doubt about it. Equity markets surging. They are off their best levels of the session, but we're seeing another leg up. This as investors wager that rate hike cycles on both sides of the Atlantic are nearing an end. We've, of course, heard from Fed Chair Jay Powell. We've also heard from ECB President Christine Lagarde, and also from the Bank of England. We've got big tech earnings. There's a lot going on, no doubt about it. And for more on where we are, at least technically, we've got Randy Watts. He's Chief Investment Strategist at O'Neill Global Advisors. Randy, Tim joining us via Zoom in Miami.
Hey, Randy, good to have you with us. How are you?
It's good to hear from you guys. I hope all is well in New York.
Yeah, it is. It is. So, technicals. On a day like today, in a week like today, in a week like this week in a year so far, where the NASDAQ composite is up 16%, what are the technicals telling you about this rally?
The market's tone has dramatically changed this year. It is a much broader market. Some of the growth sectors are starting to reassert themselves. You know, the Russell 2000 is up over 12% this year. This is all very, very positive. And while it's too early to say that a new bull market has started, these are the kind of things you see at the beginning of a big bull leg. So I think you have to interpret the data positively. And as you said a second ago, if you look at where the bond market is right now, it's dialing in an 85% chance of a rate increase in March, only a 40% chance of a rate increase in May. If you listen to what Powell said yesterday, he kind of talked about 2 more raises. If we get to the middle of the year and we're done with the Fed tightening cycle, I think the outlook for equities can be pretty positive.
Interesting. So, Randy, NASDAQ 100, we've been talking about it throughout the day, looking from bottom to top here, up about 20% here. What more do you need to see? Just seeing it alone isn't enough to say a new bull market is underway in tech?
I mean, I think what we'd like to see here is maybe a little bit of consolidation, either a sideways movement or a slight pullback. But we want to see these averages, both the S&P and the NASDAQ, stay above their 200-day. That's about 5% lower for each. But on the S&P, if you look at it technically, you're getting a positive cross of the 21-day and the 50-day through the 200. That hasn't happened yet in the NASDAQ, but we're hopeful that can happen over the next couple of months. So again, we're pretty positively inclined at O'Neill, and we're seeing a lot of positive action. And then finally, earnings, while coming in lower year to year, are not coming in dramatically worse than expected. So I think that's giving some strength to investors as well.
The bar was low, though, right?
The bar was very low. They're coming in down about minus 2.3. People were expecting down about 3%. So it is down, but it's sort of less bad than feared. And if we can go through this year, but by the way, people are now essentially expecting flat earnings for the year for the S&P. So that bar has come down very low. I think everyone on the buy side expects it to be a down year for earnings. So as long as earnings don't absolutely crater, I think you're setting up for a very positive kind of second half of the year story for equities.
But it's not hard to find companies that are saying, hey, things out there are not so great. I mean, look at Hanesbrands today. Shares are falling the most ever after the company said it expects muted consumer demand given macroeconomic uncertainty. We're going to hear from Qualcomm after the bell. Analysts are expecting a revenue decline of about 10% because of a worldwide slowdown in phone sales. Consumers are feeling the pain, so they're not, buying expensive things like phones. There are some red flags out there. It's just a question of, to me, how far ahead the market is looking.
There are some red flags, but I don't think anyone expects this to be a good year for the economy or a good year for earnings. So the market's a discounting mechanism. So the question is, as we move through the year, is it going to come in worse or better than what's expected? I think importantly with the economy, the jobs picture is hanging in there. We're going to get unemployment tomorrow. The last unemployment read was 3.5%. People are looking for 3.6. While the economy is slowing, jobs are hanging in, and that means consumer spending is not totally tanking. If we can get through this rate cycle without jobs and employment falling apart, then in the second half of the year, you could be talking about a better economy in 2024. The market looks, 6 to 12 months ahead. So I think there's a lot of things that could happen over the next 6 months that could make you feel a lot better about the future. And that's very different than where we were a year ago, where we were thinking about what was ahead of us and it was all negative things.
But we've had some head fakes. The cover of the domestic issue of Bloomberg Business Week is this whole idea of how investors at some point, Randy, have thought that the Fed was done. We saw that last year, only to be surprised that the Fed, again, wasn't done and was sticking to what it was saying. Why is it different, maybe, than what we saw last year?
Well, I think if you listen to Powell's commentary yesterday, he gave an indication that they think they're much closer to the end than they were. Second, some of the important inflation numbers are starting to come down. CPI is decelerating, PCE is decelerating, and importantly today, labor costs are decelerating. Labor costs last month were up 1.1%. The expectation was that number was going to be 1.5, and a month ago that number was 2. So if labor costs can cool a little bit without having unemployment really spike, that takes some pressure off the Fed to keep raising. And again, if we continue to see the trend we've seen in CPI, which is deceleration, then I think we're on the right path, and I think the Fed is a lot closer to being done. I'm pretty optimistic the Fed tightening cycle is going to end this year, and it's likely to end by mid-year, which is really not that far away now.
All right, Randy, thank you so much. Always appreciate it. Randy Watts, he's Chief Investment Strategist at O'Neill Global Advisors, joining us via Zoom in Miami. And you are listening to Bloomberg. We're going to stay in Miami and welcome in as well our Bloomberg TV audience and YouTube and Bloomberg Originals, our streaming service, because we've got a special guest. Kathy Wood is back with us. She's the founder, Chief Investment Officer, and CEO of ARK Investment Management, joining us from St. Petersburg, Florida. Kathy, great to have you back with us. Happy New Year.
Happy New Year. I'm really happy to be with you. And it is so far a Happy New Year.
It's definitely a different tone. Well, it's interesting. We watched yesterday, continuing today, even though we're off our highs when it comes to stocks, Kathy, it seemed the more Jay Powell talked, the more, excitement you saw and moves to the upside when it came to both stocks and bonds. Does this market reaction make sense to you, or do you see some irrational exuberance, if you will?
No, if anything, I saw an exaggerated reaction last year to fears that inflation and interest rates were embedded in the system like they were in the 70s. And we just didn't believe that at all. In fact, we were seeing a lot of early signs of inflation coming down, actual deflation surfacing. So this does not surprise us. I think what has happened here, there are 3 people who have weighed in the last week who really have changed their points of view. One is Larry Summers. Larry Summers was almost apoplectic last year. So this is the former Treasury Secretary.
Right.
Almost apoplectic about inflation. And I think he truly influenced the Fed because he was so sure that we were in a 70s style inflation. If you'll notice in the last week, he said, okay, now don't signal what you're going to do in the future. We're seeing some economic weakness here. And I think the other thing he was saying, not explicitly, was, hey, some prices are coming down that I didn't expect to come down. You know, the oil price is roughly half of where it was last March. So that's the first person. The second person was Treasury Secretary Janet Yellen. And remember, I think the market last year got really upset when she changed her mind on transitory. And I think that fed Chairman Powell as well. And turned him into an even more hawkish mode, along with the rest of the board members. She this week said that now that inflation is coming down, we're probably going to be looking at the bigger risk being kind of mired in low inflation, low growth. That was a big change. And it effectively says, wow, maybe it was transitory after all. It was just a little longer than we expected. Who knew supply chain problems would last 2 to 3 years? Who knew Russia would invade Ukraine? And then the third thing that happened, this was really important, I think, in the Q&A. Chairman Powell himself said, I agree with Lyle Brainerd. We do not believe we're in the middle of a wage price spiral. And that's another code phrase for the 70s style inflation. So I think that is what the market's responding to.
Kathy, you've talked about, though, the threat of deflation. So what's your view on that versus inflation right here?
A couple of things. We see the deflation in the pipeline because commodity prices, which are at the top of the funnel, have been coming down on balance. Now, we're seeing right now some interruptions in that as China moves away from its zero COVID policy. But I think the fake out here is China has been building inventories, particularly of energy. It's been getting Russia's energy for a 40% discount to what the rest of us are paying. So why wouldn't it build inventories? So I think that fear is probably going to be, or has been, a little overblown in terms of ramifications for inflation. And I also don't think China's taking off. But anyway, we have the funnel. We had at holiday time massive discounting. And even though we had massive discounting in the fourth quarter, inventory accumulation accelerated. That was the biggest surprise to me. Wait a minute, final sales were that punk, that inventories built, even though retailers and others were trying to clear the shelves with these massive discounts. That was very interesting to me. So I think underlying demand here is basically the consumer is railing against price increases because real average wages have gone down, and the consumer is going to win this battle.
Kathy, I want to go back to the way that you characterized what we heard from the Fed and Jay Powell yesterday, because he also said some other things, like further rate hikes will be appropriate. It's premature to declare victory. We have a lot of work left to do. And if our outlook turns true, then I don't see us cutting rates this year. What convinces you that his views have changed?
Well, I think he is looking at the bond market, and he's saying what he should say as a Fed chairman who has been very concerned about inflation. He can't turn on a dime. But just look at what the bond market's saying. The long-term bond yield peaked in October at 4.3%. And today we got down to, I believe, 3.35%. You know, if you look at the 10-year bond yield as a proxy for what effectively nominal GDP, give or take a little, nominal GDP growth will be over the next 10 years, that doesn't leave a lot of room for much inflation if we're going to have real growth over the next 10 years. So I think the markets are speaking loudly. I think the inverted yield curve We're still around 70 basis points. We haven't seen it this low since the early 80s when Volcker was trying to strangle inflation out of the system, and he did so successfully.
So, Kathy, forgive me. I want to jump in for a second. Because so are you expecting the Fed to cut rates this year?
I would not be surprised to see the Fed cut rates this year. And one of the other reasons that we're very focused on this message that the bigger risk is deflation, it's also a very big opportunity. When we look at deflation, there's good deflation and there's bad deflation. The bad deflation is caused by demand destruction. The good deflation creates demand. And that is what our research is centered on, which is technologically enabled innovation that rides down learning curves, which are expressed by cost declines, which turn into price declines. You'll notice that Tesla is cutting prices, and many people jump to the conclusion that, oh, they're having so much trouble now, there's so much more competition. No, Tesla can cut prices now that supply chain issues are passing us because it is riding down a cost curve. The battery cost curve declines. And I think its battery costs are lower than anyone else's. Its drivetrain costs is more correctly said. Are lower than anyone's out there.
Right.
And so he wants to proliferate electric vehicles to save us from environmental disaster. That is his mission. And he is going to drive down prices. When you drive down prices, units explode. It's no surprise to us, even without price cuts last year, that electric vehicle demand was up more than 60%, while gas-powered demand was down, I believe, 7%. The consumer preference shift has occurred. We are now in prime time for electric vehicles.
I want to go back to Tesla in a moment, but I want to go back to your ARK Innovation ETF. We've done the story on Bloomberg. You guys had the best month on record for the fund, up 28%. All ARK ETFs, all of the 8 ETFs are up, 7 of them in double digits. Do you see that as vindication for your investment theses? And do you think it can continue?
Yes, we believe that innovation was one of the biggest victims of the massive interest rate increase we saw last year. In less than a year, I think 18-fold increase in interest rates. It was like a massive earthquake. And the other victim, of course, was the other very long duration asset out there, long-term bonds. They were hit, at least through October, if my numbers are correct. The long bond market had not seen that bad a year since the 1700s. You know, we're not talking post-World War II. We're talking about the 1700s. That gives you a sense of the shock to the system, and the shock to our strategy was palpable. Boy, we felt it every time Chairman Powell spoke.
We're speaking with Kathy Wood, CEO of ARK Investment Management. Kathy, Carol just asked you about the performance in January, and she mentioned that it's the best month ever for the ARK Innovation ETF. The thing is that the jump in performance hasn't been met in the way of flows, with investors putting money back into ARK. Perhaps this is because it's been a tough couple of years for the ETF and for many of your ETFs. How do you win them back?
Well, actually, I don't think we lost many investors. I think the shock to most people is how well we held our assets. And our underperformance started in February of 21 when people were starting to get vaccinated, going back to work, and these fears of inflation started to surface. So since February of 21, we have seen a massive down round in our innovation strategies. And in 21, we had very significant inflows, most of which we kept. I think the net was 17 billion that year. Last year, again, a horrific year, I think for the year, our flagship was, so ARKK was inflows, more than $1.5 billion. And I think that shocked a lot of people. What we saw was averaging down. Many of our loyal shareholders did average down. And I think one of the reasons they did is we were out there every step of the way, giving away our research, reassuring our clients that actually innovation solves problems. And we have so many problems now created by supply chain problems, the war, created by the Fed, and the demand destruction, which is hurting margins, which technology will solve in terms of increasing productivity. And I think because we are so prolific in our research, our analysts are amazing in terms of the kind of original research they're doing. So our clients and others are reading research from us that they're not seeing from anyone else or anyone at all.
And I want to
even out.
And I want to get into that in a moment, because I do love it, Kathy. Like, you've got over 150 pages in your big ideas for this year, and it's a lot of things that we talk about. What I do want to ask you, though, after a 67% drop in ARK Innovation, the ETF last year, and I know it was a tough year for many assets, do you find any of your investors kind of treating ARK a little bit, more cautiously?
I think one thing that happened last year is we were able, with a number of papers, we called it our ground war. We were trying to help investors and advisors understand that if you take a look at truly disruptive innovation, which is all we do, and you look at other growth portfolios, large cap growth, growth generally, as well as the major benchmarks like the NASDAQ, you won't find much truly disruptive innovation in them. And so as we were getting hit so badly, what we also saw is investors taking tax losses in some of NASDAQ and other strategies and moving into our strategy, which was hit so hard because they did believe that we were going to rebound faster. We were hit the hardest. Our research would suggest that the $200 trillion that we expect by 2030 to be the market valuation placed on disruptive innovation, that hadn't changed. That hadn't changed. And so if you have a 5-year investment time horizon, yes, you move into our strategy. And oh, by the way, we are the new NASDAQ, which is one of the ways we were trying to convey, look, if you want to look at the future and truly disruptive innovation, the way the NASDAQ performed in the 80s and 90s, that's where we went for innovation. Well, okay, look through that now. You will not find the kind of disruptive innovation. It certainly doesn't dominate those indexes, maybe 25% of them.
Well, that's the perfect segue, Kathy, to get you to weigh in on what we look for from the companies that are reporting this afternoon. Companies like Apple, Alphabet, Amazon. These are not companies that you necessarily are betting on. These are companies that you think can be disrupted. What do you watch for with them? What can they tell us about how the economy is, and what ARK should be looking at?
Yes, well, when I say we don't own those in our flagship strategy, we do own them in some of our more specialized strategies. But these are the companies that have enjoyed incredible success. They have created big markets. And to move up 10-fold, 100-fold from here is going to be difficult. We're not saying they're not going to be successful, but we are saying a few things. Take Amazon. Amazon is not a social network. We have moved into a world of social commerce. So we own Shopify. Shopify is supporting Instagram and TikTok and others that have that are taking really social commerce and scaling it. Amazon will not become a social network. It is not one. It's a good online retailer. And I would put it in a more mature category of online retail. That's not what we do. If you look at Google or Alphabet, everyone's talking about ChatGPT, And we do believe that it is going to put search at risk. Search is 95% of Google's revenues. Now, we also believe, however, that that Google is going to harness AI as well. I mean, it owns DeepMind. It is one of the best AI companies in the world. But I think it has been so caught up in fears about legal liability associated with the dangers created by.
What about Microsoft, Kathy? And Microsoft's big investment in ChatGPT, do they have the potential to overtake Google when it comes to search because of the way they are harnessing AI?
I think that's the big threat. I think that's why Sundar went to Code Red at Google. I think they're going to become very aggressive. So yes, we absolutely are focused on what OpenAI and Microsoft are going to do together.
Kathy, one thing is, and, for our TV and our streaming service and YouTube, we've got, the share prices of Apple, Amazon, Meta, and Alphabet up there. I mean, you're looking at Meta up more than 20% today. It was higher at its best levels of the session. I do like how you think about innovation and things that are going to be impacting us in years to come. Is the metaverse something that you guys think about, that this is an important trend, or TBD?
Well, in Japan, we sub-advise a fund for Nikko Asset Management called the Metaverse. So yes, we are in the very early days of what will become very immersive digital experiences. In fact, we believe that more than half of our spending will end up online as opposed to through physical stores. And that's part of our big ideas this year. Our team, led by Frank Downing and Nick Bruce, have done a terrific job, Andrew, as well, pulling together how this new world is going to work. So absolutely we do. I think what happened with Meta last night, I listened to the call, was fascinating. I think what's happening is Meta has an answer to TikTok. It's Reels, and Reels is taking off. They're also extremely focused on using artificial intelligence as they are activating this platform. And WhatsApp is also becoming a very important platform that they have not monetized, and now they're activating it. So really, really fascinating. And, just to give you a sense, Delta is working through WhatsApp right now to inform passengers when something goes wrong and improving customer service dramatically. So, this could become a very big business use case. So, yes, lots of big markets that Facebook. The other thing that Mark did was use the word efficiency. He must have used 15 times.
Investors liked it.
And in that vein, he was using artificial intelligence as well, because as we in Big Ideas, and you can find Big Ideas on arc-invest.com. In Big Ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered.
Right.
The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. I think a lot of the hype is in companies that have AI in their names.
We talk
but
about
I think
that
the
all the
real
time.
winners, I know the real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
In your Big Ideas paper, you, again, speaking of big ideas, and I love when we talk about this because everybody on Twitter has a comment, but you stick to your $1 million Bitcoin forecast, despite what we saw, I think about a 65% drop in it last year. people are saying to me, really? Did she really stick to this? Why the confidence in that despite everything?
Well, the confidence actually was strengthened last year. Now, last year was a terrible year for everything crypto. But if you think about what happened, it was the centralized, opaque players who went bankrupt: FTX, Celsius, 3 Hours Capital, and what did we see from Bitcoin? Bitcoin is completely decentralized and transparent. It started because of 0809, the lack of transparency in the traditional financial services ecosystem. And I remember when we did our research, and Art Laffer, I mentioned him. I mentioned him the first time he was on your show.
Yep.
He took us through what Bitcoin meant to him, and it was, wow, Art. This is a rules-based monetary. It's a rules-based digital monetary system, and it's global, and there's no human intervention. It's very disciplined. It's mathematically metered to top out at 21 million units. Well, in the last year, in the last 3 years, the responses to COVID, the fiscal and monetary responses that, in many countries are causing hyperinflation and, fiscal crises. We're seeing protests and riots all over the place. Well, where do these people go for an insurance policy against an implosion in their purchasing power and wealth? It is in something like Bitcoin. Bitcoin is an insurance policy, and it is an insurance policy for everyone against confiscation of wealth.
So you're not tempering any of your thoughts, even with what happened last year. And if anything, you're kind of doubling down on your conviction because of what happened last year. Is that fair?
Yeah. We tempered a few assumptions. We thought, led by Tesla and Block, formerly Square, and MicroStrategy, that more corporations would put coin on their balance sheets. That we've dialed that one down considerably. And the same thing with nation states. El Salvador they're sticking to their guns on this one, and actually are doubling down, I believe, in terms of bond issuance backed by Bitcoin. But other countries will probably not move as quickly as they might have if El Salvador had a grand swoosh right off the bat. We do think it will happen. It's just we've pushed it out a bit. So I think our base case for Bitcoin now is in 5 years, I think roughly 670,000, something like that. And then by 2030, as we see more use cases and more of these insurance policies taken out against fiscal and policy regimes that are not healthy, we think it could pass $1 million.
Kathy, we don't have a ton of time, and I want to make sure to get to a few more of your big ideas in your research for 2023. We've talked about AI, we've talked about crypto, we talked a little bit about batteries and Tesla. In the last 30 seconds, or just the last couple of minutes that we have with you, let's talk about a few more, specifically robotics. What's appealing to you and what's exciting to you? What do you see as investment opportunities for robotics?
Well, I think everyone thinks robots have been around forever, and they kind of have, but they've been locked in cages inside auto companies and so forth. What we have now is really the dawn of the age of robotics. It's really going to happen because of battery technology and artificial intelligence. And we're talking about industrial robots. Amazon is adding 1,000 robots per day. And by the year 2030, we think that Amazon will have more robots than people, even though they will continue to increase their employment roles. Robots will increase faster. Why is this happening? Well, as always with technology, the technology's ready, and even more important, the costs are low enough now. And the technology, really AI, battery technology, critically important. And the costs, if we use Wright's law, for every cumulative doubling in the number of industrial robots produced, costs will decline by 50%. I think it's even more than that. Given the massive labor shortages that have been exposed, and we still have around the world, some of it's demographic, some of it's COVID related, the aftershocks. We think the time is ripe for robotics now. So, and you know, Tesla is a robotics company, autonomous vehicles, which is where we're going.
Right.
Those are robots. Those are robots. So we think we're going to see a lot of robots rolling around, flying in the air, drones and so forth. So, you know, and collapsing the cost of transportation.
Well, I don't know if that's so great for me. I don't know, Carol.
I'll take it. I'll take a robot to do everything. Kathy, we really only have about 25 seconds left. So quickly, if you've got some new money to commit, what's the name you buy? Is it Tesla right now?
Well, Tesla is the #1 position in two of our funds, ARKK and ARKQ, and we even have it in ARKW because it is probably the best case of a convergence between and among the most massive innovation opportunities of our lifetimes. Robotics, autonomous vehicles or robots, energy storage, they will be electric, and artificial intelligence, they'll be powered by AI. So that's one S-curve feeding another S-curve feeding another S-curve.
Going to leave it there. I feel like we go around the world with you, Kathy, and so appreciate it. Kathy Wood, she's the CEO, she's the founder, she's the CIO of ARK Investment. Check out her big ideas, 2023, 153 pages. You can find it online at ARK Invest. Kathy, thank you so much joining us from Florida. Right now, though, Beyond the Bell starts right now.
Full coverage right here on Bloomberg.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
We are 2 minutes away from the end of the trading day. Scarlett Fu here with Katie Greifeld, counting you down to the closing bell. Here with us to take us beyond the bell with the global simulcast. We are joined by Carol Massar and Tim Stanovic, bringing together our Bloomberg television, radio, and YouTube audiences globally as we parse through the most crucial moments of the trading day and get you ready for tomorrow's trading with a whole slew of big tech earnings announcements. Carol, I mean, I lose track of how much of the NASDAQ 100 this is worth, right?
I mean, 4.7 trillion, right? Apple, Amazon, Alphabet. It's a big deal. And so if we do see any kind of trend lines among them, you're talking about potential to kind of move the markets in either direction. Right now, a lot of enthusiasm. We'll see if it keeps going.
I thought it was interesting from our conversation with Kathy Wood just now in the context of Alphabet, talking about looking for how the company could harness AI, because she sees that AI could really disrupt search. And if Google controls so much search, then if they don't harness AI, that's a real threat to them.
Yeah, it was a really timely conversation, again, as we await some of these big earnings, specifically from the likes of Alphabet. I would imagine that's going to be a topic of conversation on the call that we get with executives later on.
And of course, as we wait for Apple earnings at 4:30, that's going to give us a read on the global economy because of its exposure to China, to the global supply chain, and certainly over consumers' willingness to spend on these pricey devices.
You know, this risk on trade that we're seeing that feels like, you know, everything is awesome. I mean, Kathy Wood talked about that. She said she would not be surprised to see a Fed cut in 2023, which speaks to, you know, Scarlett, what we've seen among traders, right, anticipating that we'll see that later on this year. That's a disconnect with the Fed.
Yeah, there's definitely a new spirit here in the markets. As we hear the closing bell, 10 seconds to go, but we are looking at the biggest advance in the S&P 500 since August 25th, a gain of 1.4%. We had gained almost 2% earlier in the day, but still closing near the better parts of our highs for the session.
All right, and taking a look at the S&P 500, most names higher in today's session, 330 higher, 172 a little bit lower, but definitely more risk on here, Katie.
And let's look at the industry groups. Right up at the top, we have media and entertainment. We know a lot of that is just from Meta, up over, what, 20% today? Energy at the bottom. And I believe we have some breaking news here.
Yeah, I want to get to Qualcomm because earnings just crossing right now. Shares down about 1.8% in the after hours. The company sees second quarter revenue $8.7 billion, coming in shy of estimates, missing that forecast. The estimate was for $9.58 billion. The company does see a range, though, of $8.7 to $9.5 billion. The company also expects demand and inventory to normalize in the second half half of 2023. We really got to dig into these earnings, Carol, because this is a good sort of snapshot of what the smartphone market looks like. The concern is that smartphone sales are declining around the world as companies, as consumers don't have as much money as they had before to spend on these pricey contraptions.
Yeah,
Scarlett.
let me jump in here because Amazon numbers just crossed. Fourth quarter net sales beating analyst estimates. Earnings per share looks like it is, you know what, I'm not going to go with that. It looks like a typo. But fourth quarter North American net sales topping analyst estimates by $3 billion, 93.36. Online stores net sales coming in shy of what analysts were looking for. When it comes to the guidance, it assumes no additional restructuring. So obviously cost cutting is a big theme for any tech investor this year, this quarter. Amazon, in terms of giving its guidance, its outlook, is very mindful of the expectations that have been set by its rivals in cutting costs. It sees its first quarter operating income of $0 to $4 billion. The consensus estimate is $3.5 billion. It sees first quarter net sales of $121 to $126 billion. At the high end, that does top the average analyst estimate of $125.55 billion.
And you look at what the shares are doing, man, they've been bouncing back and forth, pretty close to unchanged right now. You remember shares are down, what, 26% over the past year. And as we parse through these numbers, of course, it's going to be interesting to separate the retail side of the business from the cloud side of the business.
Andy Jassy, Amazon CEO, in the press release, we are also encouraged by continued progress and talking, though, about facing an uncertain economy. So we're getting some insight. Let's get to Google because it is crossing. Alphabet, of course, the parent of Google. Looking at fourth quarter revenue right now, hang on a second as the numbers come out fast and furious. Fourth quarter Google ad revenue, $59.04 billion. That's a light number compared with the estimate of $60.64. Fourth quarter revenue ex-TAC, always key, $63.12 billion. That is a little bit light, but pretty much spot on. The estimate is $63.24 billion here. Cloud, this is an important metric. They're not doing as well as Microsoft. They're not doing as well as Amazon. Cloud revenue, $7.32 billion. That looks pretty much as expected.
All right. Well, to Kathy Wood's point about them talking about AI, Sundar Pichai, the CEO of Alphabet and Google, saying, quote, "Our long-term investments in deep computer science make us extremely well-positioned as AI reaches an inflection point, and I'm excited by the AI-driven leaps we're about to unveil in search and beyond. There's also great momentum in cloud, YouTube subscriptions, and our Pixel devices." Literally, the first sentence of the press release, totally focused on AI. Investors concerned that, they might not harness AI the way that other companies have.
So clearly top of mind in the press release, probably going to be top of mind in the call, but just to dig into some of those numbers there, when we look at revenue, Google advertising revenue came in a little bit light, about $59 billion. The estimate had been for a little bit over $60 billion. YouTube ad revenue, just under $8 billion. The estimate was for $8.3 billion. So overall, a little bit light, but you look at the shares up slightly, about 1.2%.
Yeah, you wonder to what extent the results from Snap and the results from these other companies that do depend on advertising kind of set the tone and set the bar for Alphabet. I know that you can't compare Snap and Alphabet given that they're companies of such different sizes, but it gives you an indication of where companies are willing to spend and how they're going to deploy that cash that they're now holding on to a lot more closely than they had been the same time last year. We should add as well that Alphabet sees a charge of $1.9 billion to $2.3 billion. I don't have any further details on what those charges are related to, but something to keep in mind is it definitely takes away from the bottom line.
I will say, thanks to Matt Day on our live blog, who notes that Amazon's expectations for fourth quarter revenue and operating income missing on net income, and some of that is the noise from the valuation markdown when it comes to Amazon's stake in Rivian, the EV maker that has been under pressure.
And I should point out, those job cuts were obviously earlier this month here, and that was about 6% of its workforce, global workforce, which is the largest in the company's history, but that we got earlier this month.
All right, let's take a look at what's going on with shares of Ford in the after hours as earnings begin to cross. We're seeing shares of Ford right now, or we're seeing Ford seeing adjusted EBITDA from $9.9 billion to $11 billion. So it's within the range, but estimates were for $9.94 billion. The company out with a press release noting that I should note, well, I'm actually having trouble pulling up the press release, Katie, so if you could jump in right now and give me a little help here because it's not coming up on my screen.
Because we do have some Starbucks numbers coming out. The first quarter comparable sales missed estimates. They came in for the first quarter at about 5%. The estimate there had been for 6.8%. 8%. And the company did reaffirm its 2023 full year guidance, but you look at what the shares are doing, they're down about 4%. It's going to be interesting to get some more color on the margins, for example, because we know Starbucks has been increasing prices. I know that particularly well, but still it seems like those comp sales really spooking investors in after hours right now.
Well, and this is where you get to see whether or not consumers are starting to trade down, right? Saying, wait, I can't spend, $5 or $6 on a cup of coffee, Scarlett, maybe you've got to go elsewhere. And it's a good read on the consumer.
Absolutely. I just want to follow up on what we were saying earlier about Alphabet, because with the charges that we mentioned, Carol, thank you for putting into context the job cuts and what that means in terms of expenses for Alphabet. The company also says that it might have other charges moving forward. It doesn't give any details there either, but it's just something to watch out for, that Alphabet may incur additional charges. In addition, I think it's kind of interesting that Alphabet is also saying it's going to optimize global office space. The big tech companies were such a protagonist here in the story of the returning to office, and this idea that you could work from anywhere. They were offering definitely flexible work, hybrid work. And in this case, Alphabet is going to see its exit costs relating to office space of about $500 million in the first quarter. So perhaps right-sizing its office space, looking at it as a way to reduce its expenses.
Well, I want to get back to Ford because we're seeing additional headlines cross here when it comes to the company. Shares up more than 1% in the after hours. Ford to pay a supplemental dividend of 65 cents per share. The company sees adjusted free cash flow for 2023 of about $6 billion. And the company is also going to report based on 3 new business segments starting in 2023.
So we talked about the importance of the market value of these companies. So I'm taking a look at Google shares. They are down, Alphabet, down about 1.8% in the after hours. We continue, Katie, to see Amazon under pressure, down about 3.5%. And of course, we're still waiting for Apple.
And of course, this is after Amazon topped its revenue estimates, but it missed on net income. So it seems like that's one of the spooky things right now. Again, it's going to be interesting to hear a little bit more about the cloud business. Looks like that was a little bit light, but again, that share reaction, if we look at it right now, shares down about 3.5% or so. Again, this is a company that's been under a lot of pressure, one of those big tech names. What that means for the overall benchmark, we know it's painful when you think about just how huge this company is.
Yeah, and of course, we should caution that maybe we don't read too much into these initial trades after hours as investors sift through all the numbers and wait for the conference calls where they can get more elaboration. Maybe someone will say year of efficiency again today.
Well, I think perhaps more concerning than that, though, is what Andy Jassy said about the short term in terms of the economy here. And I think investors are really going to be looking to Amazon to say, okay, well, what does the outlook for the American consumer look like? What does the outlook for the American economy look like? And what does that mean for Amazon's business? Because what it said a quarter ago really got people concerned.
Is this all enough, though, to keep the momentum that we've seen built in the last day or so when it comes to kind of the risk on trade? I'm looking at NASDAQ E-mini futures in the after hours. They're up about 2.6%. You're right, Scarlett. It's early on, and things can change certainly dramatically as we go through those conference calls. But initially, investors are buying into it.
Yeah, buying rumor, selling news, right?
Yeah, but I mean, just to get back to the benchmark math, you think about the huge day that Meta had. You look at the S&P 500. Meta is what, 3% of the Nasdaq 100? It's 1.2% of the S&P 500. The Apples, the Amazons, the Googles, these matter a lot.
It's a lot more percentage-wise than it was earlier in the day, Katie, after having the best day in years, right?
I don't know about you guys, but I'm exhausted.
More to come. We still have Apple at 4:30.
I know. More earnings
and
to
like
come.
Kathy told us earlier, ARK is the new NASDAQ. So that's the benchmark.
I hear her say that.
That's the benchmark, I guess, that she thinks we should be looking at.
That's the quote of the day.
The volatile benchmark.
It's definitely a better year this year than it was last year for a lot of investors, including Kathy. All right, guys, that's a wrap. We know more to come, and I know you guys are going to be covering it. We're going to be covering it on radio as well. Our cross-platform coverage, radio, TV, YouTube, and Bloomberg Originals. Beyond the Bell. We will see you again, same time, same place tomorrow. 0.7% following their latest earnings update. And so it looks like some disappointment from investors in terms of the results specifically. So we're going to be listening for some updates when it comes to artificial intelligence and some other things as the call gets underway. In the meantime, we have a good guest to really break it down.
Yeah, Angelo Zeno is Senior Equity Strategist at CFRA Research. He joins us via Zoom in New York City. If you're just joining us, for Alphabet, fourth quarter cloud revenue came in just above estimates at $7.32 billion. YouTube ads revenue coming in below estimates at $7.96 billion. And then Alphabet, additional Alphabet, I should say, fourth quarter EPS coming in at $1.05. I want to start with Alphabet and get your thoughts, Angelo. I know you've only had a few minutes to look at these numbers, but what sticks out to you? And then we'll get to Amazon and more, of course.
Yeah, I think you actually kind of, through the high level stuff, pretty well out there. I mean, the cloud expectation was slightly above our view. I think the growth rate was about 32% or so. So we were looking at about 30%. So it was a slight beat on that end of things. And then, as far as the YouTube side, it was definitely a disappointment there. And, I'd expect that most investors out there aren't necessarily surprised about it. I'd expect to see further weakness in terms of YouTube here as we kind of go into Q1 as well. We'll see what the management team says there. But I think it's pretty promising, at least on the YouTube side of things, as we kind of go into the second half of the year. You start lapping some easier comps, and you've, of course, got that NFL Sunday ticket package out there, which can help accelerate growth on that side of things. And then I think as far as kind of the bottom line is concerned, that was definitely light relative to our expectation. I'm not sure why at this point in time, but probably adding to some of the disappointment in terms of the decline in shares.
Yeah, we're looking for some more color, certainly on the call. As you said, YouTube ads revenue $7.96 billion. The estimate was for $8.27 billion. Stock still down about 4%. Because they were among the big tech, Angelo, that cut jobs. We got that news from Alphabet earlier this month, about 6% of its global workforce. I think it's the biggest cut ever for the company. Are there bigger questions that you want to say? Why did you cut jobs? Is business really slowing down? Or do you just see that cutback in their labor force as just kind of a reset post-pandemic?
Yeah, I think it's more of a reset, to be honest with you. I think it was much needed, to be honest with you. To your point, I think 12,000 employees, 6% of the workforce. It definitely came a little bit late. It came later than where Meta came in at. So, it probably hasn't trickled through yet. Definitely want to hear more clarity in terms of what they expect kind of the operating margin and cost savings to look like here as we kind of go through Q1 and into the second half of the year. But I think ultimately it's the right move by Alphabet. I think it's the right move by all of tech, to be honest with you. Clearly, we've had a big run into these numbers following Meta's announcement just last night. And of course, the cost savings news came about a week and a half, 2 weeks ago. So it took some of the thunder, I think, out of this report. But at the end of the day, I think the announcement is definitely a positive.
Angela, I was pretty struck with the way that the press release for Alphabet's fourth quarter and fiscal year 2022 results began. It was like Kathy Wood, who we spoke to earlier, was kind of calling it and talking about the way that this company would focus on AI. Here's what Sundar Pichai said. Our long-term investments in deep computer science make us extremely well-positioned as AI reaches an inflection point, and I'm excited about the AI-driven leaps we're about to unveil in search and beyond. What is the status at Google, at Alphabet, of AI? And is this a company that has the potential to really disrupt disrupt itself when it comes to AI?
Well, listen, I think as far as AI is concerned, when you start thinking about who potential winners are out there, I mean, clearly Microsoft with ChatGPT really kind of disrupted and kind of, put everybody on edge here in recent weeks and months. And, Alphabet no more than anybody else. And, it almost sounds like they might be a little bit on the defense, but at the same time, they've been working on a ton of stuff on the AI side of things here over the last couple of years, and they've got technology out there that can compete with the likes of ChatGPT, and we'd expect to hear more stuff out of them here over the next kind of couple of quarters or so. But when we think about Alphabet here, we do think they are well positioned out there, and it's just a matter of kind of hearing what they have to say. But what I will say I'm a bit concerned about as far as Alphabet's move towards AI is concerned is how does it change the business model in terms of their search business and how they're going to kind of generate ad-based revenue? Because if you start thinking about conversational AI, for instance, that does kind of change the landscape a little bit as far as Alphabet is concerned. So I think that's something that investors kind of need to get a better understanding about. I don't think you will here in the near term. But at the end of the day, I think there's definitely a lot of question marks out there as far as Alphabet's business is concerned.
Hey, I want to go back to what Amazon said for first quarter net sales, 121 billion to 126 billion. The estimate out there is 125.55 billion, which says to me it could come at the lower end and be a bit of a disappointment. Is that a disappointment for you?
Yeah, I mean, I think at the end of the day, I mean, given the heightened expectations, I think that kind of went into the numbers here. And again, the run into the stock, probably a bit of a disappointment here. Again, I think what I would say here about broader tech, maybe, not only for Amazon, but also for Alphabet and Meta and Apple that's going to report in a couple of minutes, right, is I think the setup overall looks very good. I think most people knew that Q4 was going to be relatively light and the first half of this year was going to be pretty uncertain because of the macro landscape out there. But when you kind of start thinking about the cost cuts that are coming out of here from Amazon as well as Google and Meta and the others, we do think there's a margin trough coming here in the first half of the year. And as you look at the setup in the second half with the improving Forex landscape out there, with those cost cuts and accelerating growth, that paints a very nice picture, I think, for the broader tech space, including the Amazons and Googles of the world.
So was this the warning we got from Snap overblown just in the last 40 seconds that we have, or was that specific to Snap?
I mean, right now it's looking like some of the smaller players out there are getting hit a little bit more. I mean, you kind of look at the run rate here in Q1 for Snap, down about 7% relative to Meta, which is down about 2%.
Right.
I'd expect Alphabet to probably be closer to down about 2 or 3% on the ad side of things as well. So impacting Snap a little bit more, but nonetheless, I think directionally you're going to kind of see the same type of movement from relative to some of the bigger players out there.
I got to squeeze one in 15 seconds. Amazon guidance assumes no additional restructurings. Is that a little bit of a red flag? Very quickly.
I mean, we would hope for a bit more on that side of things, but you know, it'd be kind of interesting to see what the company has to say, really.
All right, so appreciate what you had to say. Thank you so much, Angelo Zeno. We know it's busy, but quick reaction to those Alphabet earnings. He's senior equity analyst at CFRA Research via Zoom in New York City. Shares of Google, Alphabet, forgive me, of course, the parent of Google. Okay. I look at the ticker and I say Google. They're still down about 4.4% in the after hours.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. I'm Charlie Pellet. We check the markets all day long at Bloomberg. We are on earnings watch big time, especially if it begins with A. We are awaiting the latest numbers out of Apple. Apple shares after hours down now by about 0.7%. Amazon, Alphabet, they are lower after mixed results. Amazon projecting lackluster revenue in the current quarter. After hours, we have got Amazon down now by about 4.5%. Google parent, Alphabet, reporting fourth quarter results that narrowly missed analyst expectations. Right now, we've got Alphabet down by 4.6%. Lots of other big, well-known companies also reporting. We've got Qualcomm, the largest maker of smartphone processors, also delivering a lackluster quarterly sales forecast. But after hours, Qualcomm shares, they are advancing by about 0.4%. Turned out to be a mixed day, big day. Fed funneled through today with the S&P up 60, a gain there of just about 1.5%. Stocks rallying for a third day as traders anticipate the Fed's tightening cycle may be nearing its peak. 10-year yield 3.39%, the 2-year 4.09%. Again, the S&P up 1.5%. The Dow, however, a down day there, falling 0.1%, down 39 points. NASDAQ rallied 3.25% today. NASDAQ 100 index was up by 3.6%. Bottom line here, our coverage will continue. Lots going on in Techland as we await the latest numbers out of Apple. We have got gold today down $38 the ounce, down 2%, $19.12 on spot gold. West Texas Intermediate crude down 0.8%, $75.83 a barrel. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Yep, watching all the earnings in the after hours. We want to go back to Amazon, which is down more than 6% here in the after hours. The earnings, of course, did come out. The company projecting lackluster sales on slower cloud unit growth. So that is certainly some concern. That has been certainly a big, important number, if you will, and unit to both the top and bottom lines.
And just think back to 3 months ago, Carol, when it gave a lackluster outlook for the holiday sales quarter and the repercussions that had. Let's get
Although
into
holiday sales actually did okay.
Exactly, but like you said earlier, the bar was low because of that outlook. With more on that, we turn to John Ehrlichman. He's the co-host of Bloomberg Markets on Bloomberg Television. He joins us via Zoom in Toronto. John, always good to have you, especially when it comes to tech earnings, or these companies you follow so closely. Amazon had a few minutes to dig into it. What sticks out to you?
Well, I think that we have a comparable here, Tim, in the sense that Microsoft gave us an early indication of the challenges on the cloud side. So over the last day, we talked about the differences between digital media players, right? Snap, the market reaction is negative. Today, the reaction to Facebook's Meta is positive. Here in Amazon's case, because you have that dominant Amazon Web Services business not having the same kind of growth profile that we've seen in the past, that does seem to align with the story of the cloud challenges. We're watching that, obviously, in the Alphabet story as well. Now, in terms of the overall revenue picture, I mean, we are still talking about a company that now has put together its first $500 billion revenue year. But clearly on the part of the business that we talk so much about, the shipping side of all the e-commerce activity, at the end of the day, the engine of profit growth for Amazon for so many years has been AWS. So it does seem like that storyline, to your earlier point, is getting attention. The fact that they had that early beat for the fourth quarter was encouraging. People took a second look at the guidance, and it now seems like we have to wait and see what Andy Jassy perhaps delivers to investors on the financial discipline messaging that we get out of the conference call today.
So is it, so just okay in terms of the Amazon quarter? I mean, I look at them, it's always like, the law of large numbers. I mean, revenue was up 9%, $149.2 billion to wrap up the final quarter. Analysts were looking for 145.8. I mean, the stock's down 4%. If you had to kind of hone it down to one nugget, is it the cloud, which is so important? Is it a little bit of everything? What is it?
I think when it comes to bottom line performance, Carol, we've talked about this over the last really half dozen years. The fact that the success of having a business like that scale really gave Amazon that top line and bottom line story, right? So if we're talking about a slowdown for the consumer, that's a big question mark for an Amazon on the e-commerce business. But here in this case, the profit story has truly been Amazon Web Services. So more clarity on how Andy Jassy, who obviously took over from Jeff Bezos and helped to build that cloud empire, what he has to say on that will be very helpful. I would add as well that any continued clarity on the cost-cutting measures that we've seen from this company, I mean, let's not forget, we've talked endlessly, you've talked endlessly about all the layoffs in the sector. They have been going through the biggest restructuring on jobs in the company's history. And I would imagine we'll continue to get more color on that because in many ways they are pulling back on that aggressive footprint we saw through the pandemic, including not just workforce, but warehouse related as well. Those are the kinds of levers I would imagine investors are going to be watching for. I think, though, what has also complicated this trading day, and you guys have already talked about this, I mean, when you see the kind of massive meta move that we saw today, it kind of skews the direction of tech in the after hours here.
Hey, John, I know we're jumping around a little bit, but I'm thinking Amazon and retail here. And as our live blog notes, Spencer Soper writing that Amazon's core business of selling things online in the U.S. lost money for the 5th straight quarter. And the income outlook doesn't look like the 18,000 layoffs announced are significant enough to reverse that trend. One thing that's puzzled me as we await Apple earnings is why Amazon doesn't have more pricing power. It seems like they could just raise prices ever so slightly on so many products that it sells all the time, and the convenience of being able to buy it and have it to you in such a short time could make up for the fact that it's just ever so slightly more expensive than other places.
It's a great point, Tim, and I'm sure there are a pocket of items where maybe you can play around with that. Maybe what complicates that story is that Amazon works with so many other players, and the messaging from that is always a bit complicated. And if you think back to the origins of this business, they were always customer first. And I think that they were willing to spend at their own expense to keep the price down for consumers for so long.
Yeah, one thing I found notable when I was going through the press release was Andy Jassy using the word relentless as the second word in there. I mean, you'll think back to the history of Amazon. Yeah. Relentless.com was how Jeff Bezos, was one of the websites that Jeff Bezos used to actually start Amazon. That's what
This is a very good point. Good history lesson here as we cover these earnings as well, Tim. And I think, to that point as well, there's going to be some choices consumers have to make over the course of 2023 on where they want to put their money. I understand the idea of the temptation of raising prices, but what about the temptation of stealing business away from other merchants or other e-commerce players in a year where Amazon already has such a large swath of the market? And maybe that is part of the bigger game plan for 2023. Maybe Andy Jassy will build on those relentless comments.
All right, let's just remind everybody, we're speaking Amazon with our own John Ehrlichman. It is down about 3.5% here in the after hours. This following its latest update on earnings. You've got shares of Alphabet. They are down about 3.7% here. As well. And then, of course, we're awaiting Apple, which should be crossing, and they are as we speak. So let's go to it. Apple first quarter EPS, $1.88 versus $1.94. That is a miss. First quarter revenue, $117.15 million. That, too, is a miss. $121.14 billion is the estimate out there. iPhone revenue, of course, so key to this company, $65.78 billion. That is light. The estimate by the street, $68.3 billion. We are highlighting for our Bloomberg terminal users that first quarter revenue, again, a light, $117.15 billion versus 121.14 estimated. The stock is down about 3.8% here in the after hours.
As a reminder, it's the holiday quarter is the first quarter for the company. It's the most important quarter. It's the company, usually the quarter where the company sells the most. We're seeing shares of Apple continue to drop after hours. Carol, down 4.3%. First quarter EPS coming in below estimates at $1.88. Estimates were for $1.94. First quarter revenue, Carol, $117.15 billion. Estimates for $1.21. 121.14 billion, so missing both on the top line and on the bottom line.
All right, also commenting, this is in, I'm assuming, the press release here as we cross with some headlines. Apple saying a difficult macro environment, supply constraints. also saying that it has over 2 billion active devices as part of its installed base.
That's big.
So we talk about the Apple network, right? And I talk about it in my family home. It's an Apple home, and you definitely see it. Greater China revenue for the first quarter, that was better than forecast. 23.91 billion versus an estimate of 21.8 billion. That could be, as we've seen, a reopening. John, we do see Apple down almost 5% in the after hours. Come in on it. What jumps out at you?
Well, I think there were two things everybody wanted to know, and Tim alluded to the fact that the holiday period was not going to be a quote-unquote regular period for Apple for a couple of reasons. First of all, the China factor was always going to be challenging for Apple. They had already telegraphed that, the fact that all the production snafus that they'd been dealing with there were going to limit the amount of product they could get into the hands of willing iPhone 14 buyers. Plus, you add to that some of the uncertainty in the economic environment we're living through right now. Would people want to pay up for as many iPhones? One could argue that the story of this quarter is some of those logistical issues. The iPhone revenue itself, several $billion short of expectations. Yeah, that. And yet, should we be overly surprised by that, Tim? I mean, I think the company is certainly trying to find a positive spin on this by highlighting record services revenue. And to their point, revenue was up from last year, and that is increasingly an important part of the Apple empire. Carol mentioned the China revenue being better than expected. I really think that investors are going to want to key into what the China roadmap is for this year. So hopefully there'll be some clarification, not only, for example, with the appetite for iPhones among Chinese consumers as the reopening plays out, but also have they worked through some of those production snafus that would allow them to have a more encouraging second quarter, which, is typically you see a drop, and not to confuse things, because we're talking about some companies like Amazon with their fourth quarter. We're in the fiscal Q1 for Apple, but that's the holiday quarter. Now in Q2, can they make up some of the difference in what is typically a lighter quarter?
I want to go back to this 2 billion active devices as part of the installed base right now, because one key question that analysts will be asking on the call, that investors will want to know from Tim Cook & Co., is how you continue to extract more money from people like Carol, from people like me. John, I don't know if you're an iPhone user, but perhaps from people like you, people who are indeed stuck in that Apple ecosystem. Like you said, we're certainly going to hear Apple tout that services revenue number. But how do you get the people who are already in the ecosystem to spend even more money?
I mean, they've never had, isn't it shocking in this world we live in that when people have to make tough decisions, Apple still finds a way to get people to upgrade to new phones. But I think that, to your point, maybe the easier sell longer term is getting people to use more within the phone ecosystem. We talked about how they highlighted the services revenue being a record. You guys highlighted the fact that they're putting it out there once again on just how many devices are being used around the world. This has really been part of a playbook Apple has been rolling out for at least half a decade at this point, because there was going to be the law of large number. There was going to be, or at least there was the assumption, there would be a point where they could not sell as many iPhones. So far, Tim Cook's messaging, and I've seen that in some of the interviews he seems to be giving in reaction to these results, is to say services is growing. People are within our ecosystem. That's a positive. And on the iPhone specific side, in terms of selling more devices, we're going to be hearing this narrative about supply chain constraints.
Right.
And I think at the end of the day, the market is going to interpret that as, okay, well, maybe there was some missed sales that they would have had that not been the case. And we'll see what else they have to say on that front. But I think that the easier sell, undoubtedly, is to get people to use more within the Apple ecosystem going forward. And that's part of the plan, is they want to have you within their world, buying devices sometimes, but using services all the time.
Got to say, though, when Apple has problems with its supply chain, I mean, they are a master at their supply chain. So when they are continuing to have problems, I want to know what more specifically is going on, because we keep talking with ports and different people in logistics who are saying, hey, things are getting back to normal. Let's just remind everybody, we're talking with John Ehrlichman. We're right now talking about Apple, which just crossed a few minutes ago. Stock down about 4% in the after hours. Big reason why: revenue, profit, missing estimates. iPhone revenue was a miss. We were just talking about that with John, 65.78 billion versus an estimate of 68.3 billion. This quarter, an important one. It's the holiday quarter. A lot of buying goes on. I recently bought some new earbuds.
I think you need a new Apple Watch, too.
I do need a new Apple Watch. Mine's really old. But you do wonder, right? This is where we want to hear, John, the outlook in terms of what the company says going forward. Are they a little bit nervous? Are they feeling more upbeat? Because right now it looks like there were a bunch of misses through a bunch of their categories.
The fact that they are letting it be known that there are macro headwinds right now, I think is a message that the challenges are twofold. They are on the manufacturing front, but clearly the economic climate plays a role in this as well. Now, as we were mentioning earlier, Tim Cook is already indicating that he feels that had they not had some of those issues, which we talked about on your very show recently, you know, you think about some of the challenges that Foxconn had been dealing with, that key supplier for Apple in China. Had they not had those issues, which were very much COVID related and beyond, the iPhone sales themselves would have been stronger. So from that, you can anticipate some of that moves forward into the next quarter. But remember, we did get what really was a rare warning from this company going back to November about this disruption and what it would mean for iPhone 14 deliveries. It does seem like since that period of time, some of those supply chain issues have normalized. We have seen some analysts speaking to that very fact. And I guess if you're a company that has this services business where you can push that narrative even stronger with good reason. I mean, just looking at that part of the business,
right?
And that's the App Store. It's Apple TV Plus, right? We're now at north of $20 billion worth of revenue. And certainly that's been the goal of Tim Cook. How do we strengthen the business beyond just all-out iPhone sales?
Can I just say, I recently had to do some work with my taxes, and I was just amazed at the amount of
I guess it is
the amount of money as I was going through my year-end statements of that goes to Apple.
I know, every
for
month.
Services, for cloud, for you name it.
Yeah, and I try to do the family stuff, so it's less expensive, but it's still a lot of money. Hey, John, in a sense, I'm kind of surprised, given how ugly this quarter was on the top and bottom line, that we're not seeing Apple shares down more than 3.3% in the after hours right now. What do you make of that?
Well, I think the fact that they had already telegraphed the supply chain issues is one consideration. It's possible that if they were to say more on the macro headwinds, to Carol's earlier point, like if Apple can't get there, that is a larger concern. But I think it's compared to some of the other technology stocks, they're not apples to apples, no pun intended, but if you think about the story of Meta, the sentiment had grown so negative on that business, given all the headwinds they were facing. We see the stock rocket up again. Now, Apple, by comparison, if we take a look at the past year of performance versus some of the other technology companies, a little more steady Eddie. I mean, let's not forget, this is a core holding of Warren Buffett's Berkshire Hathaway. We don't think about this it's massive, but we do not think about them having the same kind of revenue growth, arguably in percentage terms, at this stage of its lifespan, as maybe some of those other technology companies. I mean, we definitely have storylines today about weaker revenue growth, in some cases negative revenue growth, as we look through these stories of Amazon and Alphabet and Apple as well. But that would be my take, Tim, is that Apple arguably does not have as big a swing as some of its competitors. I think the other thing is here, we can always look for any clarity on the shareholder-friendly moves that they can make. And this is a company that over the last at least half dozen years, arguably a decade now, has increasingly tried to make those shareholder-friendly moves. Arguably, that's a dividend play for a lot more investors, and maybe that influences the stock moves as well.
All right, John, really appreciate deep dives into all of these big tech after the close here. John Ehrlichman, co-host of Bloomberg Markets on Bloomberg TV, joining us via Zoom from Toronto. Just a real quick recap. You've got Apple down about 4% here in the after hours as revenue profit miss estimates. You've got Amazon down about 5.5%. as it projects lackluster sales on slower cloud unit growth. And then what am I missing? Alphabet, right?
Yep.
It's down about 4% here in the after hours. This as we see some concerns about some of the metrics there as well.
Yeah, especially ad spending when it comes to YouTube.
Yes.
I think the question is, Carol, what happens on the calls later?
Yeah.
These calls haven't happened, and certainly we'll bring you updates as we hear them on Bloomberg TV and Bloomberg Radio. But a lot can change from the after hours to before tomorrow.
But across the board, all down,
All
over
down.
disappointment. But there's also been a lot of enthusiasm in the market. All right, let's get back to it. I know Charlie's been listening and covering this as well. Here is Charlie Pellet with the Bloomberg Business
Thank you
News.
very much. Lots going on after hours, and you got the right radio station to keep you covered right here on Bloomberg Radio. Earnings were all over them. This update brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. In about 8 minutes, you can find out if your business qualifies for employment retention credit assistance. Innovation Refunds has helped thousands of small to medium-sized businesses claim the ERC and may be able to help yours too. Time's running out to claim the ERC, so get started today. Learn more at getrefunds.com. Apple shares down 4%, as we heard from our John Ehrlichman. Apple reporting a steeper sales decline in its holiday period than Wall Street feared, showing the toll of an economic slowdown and lingering supply snags. Amazon projecting lackluster revenue in the current quarter. Amazon down 5.5% after hours now. Google parent Alphabet reporting fourth quarter results that narrowly missed analysts' expectations, signaling lower demand for its search ad business during a slowing economy. And Qualcomm, the largest maker of smartphone processors, also delivered a lackluster quarterly sales forecast, signaling that a slump in mobile handset sales is dragging into 2023. Turned out to be a mixed day on Wall Street today. The Dow lower, S&P, NASDAQ both higher. NASDAQ surged, but what about the market backdrop? Randy Watts is chief investment strategist at O'Neill Global Advisors, and he was our guest right here on Bloomberg Business Week.
The market's tone has dramatically changed this year. It is a much broader market. Some of the growth sectors are starting to reassert themselves. The Russell 2000 is up over 12% this year. This is all very, very positive. And while it's too early to say that a new bull market has started, these are the kind of things you see at the beginning of a big bull leg.
But what about the economic outlook? ARK Investments Chief Investment Officer Kathy Wood was interviewed exclusively right here on Bloomberg Business Week.
If you look at the 10-year bond yield as a proxy for what effectively nominal GDP, give or take a little, nominal GDP growth will be over the next 10 years, that doesn't leave a lot of room for much inflation if we're going to have real growth over the next 10 years.
S&P today up 60, a gain of 1.5%. NASDAQ Tech, also the big standout today. NASDAQ, the composite index, up 3.25%, up 384 points. NASDAQ 100 index up 3.6%. The Dow down 39, drop there of 0.1%. 10-year yield 3.39%. Spot gold down 2%, 19.12 the ounce. West Texas Intermediate crude down 0.7, 75.89 a barrel. And that is a Bloomberg Business Flash.
Covered it all. You're amazing. Charlie Pellet, thank you so much. So, whoa, what an afternoon. Big three names in our universe, Apple, Amazon, and Alphabet, as you just heard from Charlie, and as we've been covering, huge in terms of market value, market cap, and market influence. They're all down in the after hours, and can't wait to get to our next guest.
James Chakmak joins us right now. He's a partner and technology analyst at the asset management firm Clockwise Capital. He joins us via Zoom in Miami. I got to tell you, James, I don't even know where to begin. Carol had the great idea to just ask you, hey, what are you obsessed with right now? Which earnings report?
Well, luckily enough, we were happy with Meta's earnings. That was one of our top three positions, Meta, Amazon, and Uber.
That's so yesterday.
Wait, are you going to sell? Are you going to sell after this bump, or are you going to continue to hold?
We actually trimmed slightly. It was a 12% position. We trimmed it down to 10, Meta heading into the print. But we're letting the rest of it ride.
Okay, so
at this point,
why did you trim it ahead of the print, though? What was concerning you?
You had Snap earnings, obviously. Obviously, we thought that it was more Snap specific, but you never know. But much more importantly, it was the Fed. We didn't know, with the definitiveness, what Powell would do or say. We knew it was going to be 25 basis points, but the press conference, always leaves a question mark. So we just wanted to de-risk heading into that.
All right. So Apple, Amazon, Alphabet. Which one do you think?
No, Uber, not Alphabet. Thank God.
What? No.
But today, though.
No, today. So which of these big three? Because they're all down about 4% or so in the aftermarket. So which one do you think investors should take note of first?
Well, I'm most closely looking at Amazon. I just think that the profit guidance was a little bit light when you look at Q1. Clearly, the cost minimization efforts are taking longer to flow through than I think I expected, and obviously the market expected, hence why it's down. But the top line resiliency is there. AWS margins were actually better than I thought. It's still down quarter over quarter, but at the same time, the rate of decel in the margin slowed relative to the last couple quarters. So I think there were good green shoots in there to be happy about, but I think we have to wait for the call to see how exactly they're going to talk about expense management in 2023.
Didn't we know this was coming thanks to Microsoft, though?
I don't really peg the miss on AWS, but more so the ability to right size the business within their North American international segment. So I mean, on an absolute dollar basis, international sales were down over last year, but at the same time, expenses were up. So I mean, those are the kind of things that they need to fix.
What are you more concerned about with that Amazon? Are you more concerned about cloud growth deceleration or the core business?
I think that's a fun thing to talk about and people to run away with, but on the cloud decel, but I think it's going to normalize and then re-accelerate. I'm more focused on their ability to cut costs and right size. They overhired and now they have to fix it, but they're just taking a little bit too long.
Just got a couple of minutes left here. 40 seconds on Alphabet. Thoughts?
Yeah, I think that there's some structural challenges there. With the growth in AI and its potential proliferation, you look at companies like Meta, Amazon, and Microsoft to conceivably benefit from that. And also, obviously, you have the privacy benefits of moving in that direction versus, collecting the data like Google does and knows everything about you. So I think that's something to watch, but that's going to be a longer term thing. Near term, the ad market is facing challenges and Google and Alphabet, obviously are not immune either.
James, last bit. We got less than a minute left. Weigh in on Apple. Shares are down by 3.2%. iPhone, Mac, wearables all came in below estimates. Miss on the top line, miss on the bottom line. What are your takeaways?
I mean, at least the retail data that you've been seeing coming out every month is proving to be correct. People are pulling back, and inventories need to clear through in many respects, not as much for Apple, but for other companies. So obviously there's going to be some weakness there. But I think the overarching point following the Fed yesterday was that I think the probability of a soft landing is up. And I think that there's a lot of market participants who've been on the sidelines, fully hedged, scared of entering. And I think that new money could flow into the markets, and that could keep the markets slightly more elevated than not, at least over the near term. So we're becoming more constructive, not less.
Yeah, money flow is going to be important to watch. I would certainly see, especially with all this, at least initial positive momentum. James Chakmak, thank you. Partner, technology analyst at Clockwise Capital via Zoom from Miami. Right now, Amazon's down about 4%. Google's down about 4.2%. Apple down about 3%.
company news headlines on Bloomberg Radio.
It is 4:53 on Wall Street. From Bloomberg World Headquarters, I'm Charlie Pellet. Apple shares now down 3.3%. Lots of earnings after the close of trading. Apple reported a steeper sales decline in its holiday period than Wall Street feared, showing the toll of an economic slowdown and lingering supply snags. Amazon projecting lackluster revenue in the current quarter, worrying investors that the company's main e-commerce business has stalled and sales growth has slowed in the cloud computing division. Shares lower after hours. Right now, Amazon delivering a decline of just about 3.5%. Google parent Alphabet reported fourth quarter results that narrowly missed analyst expectations, signaling lower demand in its search advertising business during a slowing economy. After hours, Alphabet down now by 3.7%. Harley-Davidson reporting fourth quarter profit and revenue that beat estimates. And with more on that story, here's Bloomberg's Steve Rappaport.
Shares of Harley-Davidson are roaring, fueled by fourth quarter profit and revenue that beat Wall Street estimates. The Milwaukee-based motorcycle maker reported sales of $1.14 billion. Analysts predicted $920 million on average. Harley-Davidson's CEO slashed costs, pulled out of underperforming markets, and tightened inventory as part of the company's turnaround plan. Harley projects revenue growth of as much as 7% for the year. Steve Rappaport, Bloomberg Radio.
Of course, Harley's ticker symbol, just like the motorbikes, HOG, H-O-G, rallying today by 10.7%. Meta Platforms after earnings up 23.3%. Those are some of the company stories we're following. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
It's Bloomberg Business Week. More Business Week continues in just a few minutes. In the meantime, important update on world and national news. We go to Nancy Lyons in our 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. A special celebration took place at the White House this afternoon to commemorate the 30th anniversary of the Family and Medical Leave Act that guarantees many Americans the ability to take up to 12 unpaid weeks off to recover from major illness, childbirth, or to take care of a sick family member. It was one of the first pieces of legislation signed by former President Bill Clinton.
The bill was the result of years of passionate advocacy and effort by so many people.
Clinton says it took numerous vetoes as well as support from Republicans before it passed. The goal of creating paid family leave received a long round of applause at the event. That bill failed to pass in 2021. The House today did pass a resolution denouncing the horrors of socialism. Most Democrats joined Republicans in voting for it, but many Democrats were dumbfounded the proposal was even necessary. We get more from Bloomberg's Irv Chapman.
The resolution was presented by Chairman Patrick McHenry.
It outlines the pain and hardship experienced by millions around the world who have suffered under a socialist regime. There's nothing in this resolution about banning social services or anything of the like.
Opposition was led by Ranking Democrat Maxine Waters.
This resolution today does nothing except spread lies and fear about a threat that doesn't even exist.
Both sides used the debate to cite policies they oppose. For Republicans, climate change regulations. For Democrats, threats to Social Security and Medicare. In Washington, Irv Chapman, Bloomberg Radio.
U.S. health officials are advising people to stop using Esri Care artificial tears. Those are over-the-counter eye drops. They say they've been linked to an outbreak of drug-resistant infections in the blood, urine, and lungs. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. This is Bloomberg. Back to you, Carol and Tim.
All right, Nancy, thank you so much. All right, we're going to get back to earnings in just a moment, just a recap. But we did want to mention a Bloomberg exclusive that crossed a few minutes ago. U.S. prosecutors in the Justice Department's fraud unit are looking into Silvergate Capital's dealing with fallen crypto giants FTX and Alameda Research. This is according to people familiar with the matter. You know, remember, Silvergate really modeled itself as a go-to bank for crypto companies and was an early provider of services catering to the industry. So the investigations continue and the tentacles continue to spread.
Okay, so we got a lot happening when it comes to earnings after hours. I'm going to give some high-level stuff right now. Alphabet revenue missed in the shares have dropped. Google search ad revenue falls versus prior year. When it comes to Alphabet in after hours, down 3.8%. Amazon beat on revenue, but it missed when it came to the bottom line, net income. Amazon Web Services revenue disappoints. Shares right now down about 4%. Carol, we've got some calls going on when it comes to Alphabet right now. Amazon just had a media call where they laid out some details about layoffs. The company's CFO saying that the layoff round at Amazon is over and gave a breakdown of the $2.7 billion catch-all charge that they took.
Yeah, it's really interesting. And this is going to see, we're going to watch as these calls continue, as they wrap up, whether or not we see any change in the stock prices, which, as you mentioned, Tim, are all off about 3 or 4% here in the aftermarket, and whether they deepen in terms of the losses. But they are talking about headcount. They are talking about costs. I think kind of collectively